Sir, shall we start?
I am ready.
Okay, sir. Good afternoon, friends. I, on behalf of the 5 branches of SIRC of ICAI, namely ALAPPUZHA, KOLLAM, KOTTAYAM, THRISSUR and Thiruvananthapuram, I welcome you all to the webinar on accounting standards, the 3rd day. We have the great faculty from Bengaluru, CA Gururaj Acharya, who is leading the discussion today. And I'm happy to invite you all to this program. And before we start, let us stay for the Institute's motto song.
Yaesha supteshu jagrati Yaesha supteshu jagrati Kamam 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 pursho nirvimanaha Tadeva shukram Tasmin lokaha shataha sarve taduna kaschanatyati kaschan etadvaita
Chairman of all the 5 branches, learned speaker of the day, our Guru, CA Gururaj Acharya, my dear senior members, managing committee members of all the branches, and fellow members. I, CA Prashant Srinivas, Chairman of the Kottayam branch of the Institute of Chartered Accountants of India, have immense pleasure in welcoming our chief guest, our resource person of the day, CA Gururaj Acharya, who has readily agreed to our invitation, and we have in our midst one of the greatest gurus in accounting standards. And I welcome you, sir, to this webinar. Our pillar of strength, our SIRC member and immediate past chairman, CA Jomon, sir, has been instrumental in conduct of this program. Without his guidance, it would have been very difficult to organize this program in this style. So I welcome Jomon, sir, to this webinar. I welcome all the branch chairmen of the 4 branches, managing committee members of all the branches, senior members, and my dear fellow members, and let us all make this program a grand success. Is Jomon sir available there?
He joined.
Joined no. Jomon sir?
Yes, Prashant. I was not able to log in. Thank you so much. Yeah.
Okay. Before we start, I request Jomon sir to say a few words about this program and how it went on in last 2 days.
Thank you, Prashant. Good afternoon to all of you. Chairman of the 5 organizing branches from Trivandrum, Ramesh, KOLLAM, Praveen, Alappi, Rajneesh, Kottayam, Prashant, who is the chief coordinator today, very well organized, and Aryan, THRISSUR, secretaries of the 5 branches, managing committee members, respected senior members, and most importantly, our very, very resourceful resource person today, a very dear friend. I take that freedom, but more a patron, Gururaj Acharya from Bangalore, who is a reservoir of knowledge on accounting standards, Ind AS, income tax. We have heard him on a variety of topics, and he's one who spends a lot of time on learning and updating himself. And I vividly recall the support he has given during my chairmanship 1920. A lot of programs we could organize across region, and today is no different when we plan this 3-day program on accounting standards covering the commonly applicable standards, accounting standards for members of these 5 branches. He was very, very happy and prompt in agreeing to be a faculty here. The program is taken off well, and yesterday and day before yesterday, we had a good turnout. Today, a Saturday evening, but happy chairman, 5 of you have hit 100 in a short span of time. It's ticking in, and extremely happy that I could be part of this event. Gururaj sir, I always say that he is a guru, he is Raja, he is Acharya. So what more do you need? And he lives up to the name when it comes to matters of professional interest in sharing, more importantly, in disseminating information. He has been absolutely selfless, taking time off his busy schedule with the kind of in-depth knowledge and the command he has. He's a very sought-after consultant in the happening city of Bangalore, and he has been very supportive, and we interact very, very frequently and closely. And our second generation also, Sir's son Amog and my daughter Leah, they were batchmates in St. Joseph's BCom professional batch. Both of them have graduated. So I'm extremely happy that Sir has again consented to come to God's own country, Kerala. And this initiative is a collective of 5 branches. And thank you so much for that. And today we are covering 4 important standards. We have called them up to 15, where like for people like us, it was the first generation standards up to 15. Employee benefits. Then 16 onwards, we call them new generation standards. So when we discuss this on day 3, and a real expert should come in and explain the nitty-gritties of
disconnected, I think.
I think Jomon sir missed his line.
Oh, yeah, disconnected. Got it.
Anyway, let us move to the next item in the agenda. I request CA Jean Paul, Secretary of THRISSUR branch, to formally introduce to us our speaker, CA Gururaj Acharya.
Thank you, Prashant sir. Am I audible?
Yeah, audible.
Okay, thank you, sir. Good afternoon, everybody. Respected past SIRC Chairman, CA Jomon K. George. Respected faculty, CA Gururaj Acharya. Chairman of all branches, CA Rajanish R. ALAPPUZHA branch, CA Praveen Narayanan, KOLLAM branch, CA Prashant Srinivas Kottayam branch, CA Ramesh Kumar Thiruvananthapuram branch, and CA Aryan KK THRISSUR branch. Managing committee members of all the 5 branches, and my dear members. I'm extremely excited and privileged to introduce such a wonderful person. CA Gururaj Acharya hails from the humble town Udupi, brought up in the Iron City, Bellary, and settled in knowledge city of Bangalore. When we go through his academic life, any results less than rank is unsatisfying for him. He was the first rank holder. He was the first rank holder in BCom from Gulbarga University, 21st rank in CA Intermediate, and a 10th rank in CA Final. He is also the first rank holder of ICAI Intermediate and the 3rd rank holder in ICAI Final. He is a senior partner in Mrs. KG Acharya and Company, Chartered Accountants, Bangalore. He is a member of the Bangalore Financial Reporting Review Group, formulated under the Financial Reporting Review Board of ICAI, New Delhi. He was the director of the Board of Directors of State Bank of Mysore. He was a member of the Karnataka State Level Audit Advisory Board. He was also a co-opted member of the Expert Advisory Committee and the Committee on Accounting Standards for Local Bodies by ICAI, New Delhi. Authored a book published by Karnataka State Chartered Accountant Association titled Internal Financial Control, Practical handbook on audit report, what can go wrong. He's an expert and resource person for accounting standards and standards on auditing. He's Act 2013 and LLP, corporate finance and financial analysis, corporate tax and tax audit. In these words, let me introduce CA Gururaj Acharya, Speaker of the Day. Thank you, sir.
Thank you, Jean Paul sir. I now request our learned speaker, CA Gururaj Acharya, to take over the proceedings. Sir, forum is all yours.
Thank you, Mr. Prashant Srinivas, for inviting me on stage virtually. And I thank Mr. Jean Paul for that lovely introduction, passionately introduced. Thank you so much. And of course, I should really thank Mr. Jomon K. George, who was the, as you said, the pillar for me to be here in the God's own country at this point in time. You have been listening to, I was just saying I'm addressing 5 different places on 4 different standards, which was actually held for 3 different days by 3 different speakers. So today is the 3rd day, and as Jomon was talking about the 2nd generation standards, one may call it as a 2nd generation standards. I'm talking on 16, 18, 22, and 29. I'll put up my presentation, but before I go into my presentation, let me just tell you the importance of accounting standards. As we all know, accounting is not the end of all. Accounting is only a raw material for the preparation of the financial statements. So therefore, we always say financial statements form the raw material for various decision makings. It could be for income tax, it could be for GST purpose, it could be for audit or for whatever purpose. So financial statements finally become the end product. So therefore, I always ask this question. I would have loved to ask this question if it were to be a real session. Accounting standards internationally were called as International Accounting Standards. They changed the name from International Accounting Standards to International Financial Reporting Standards. And today, classically, I keep asking this question: what is the difference between International Accounting Standards and International Financial Reporting Standards? If you ask, the answer is the same as whatever was the difference between KOLLAM and KOLLAM. Whatever is the difference between KOTTAYAM, of course, there's no change, like the accounting standards in India. Like ALAPPUZHA becoming ALAPPUZHA, or THRISSUR, and for that matter, Trivandrum becoming Thiruvananthapuram. So in that same breath, international accounting standards has become international financial reporting standards internationally. Now, if I may ask a question, maybe I would love to ask this question: why did Trivandrum become Thiruvananthapuram? The answer is very simple. Maybe we can say that Trivandrum was the people, the English people could not pronounce Thiruvananthapuram or ALAPPUZHA or KOLLAM. So therefore, these names were the Britishers, when they came to suit themselves, to suit their tongue, they changed the names, and therefore we had to go back to our own original terminology called Thiruvananthapuram, etc. Now, if I ask the same question as to why international accounting standards were called as International Financial Reporting Standards, so which means international and standards are common in both. Only accounting has been replaced with financial reporting. Accounting has been replaced with financial reporting. Ramesh Kumarji, if you can unmute and tell me what could be the reason why they changed it from accounting standards internationally to financial reporting standards.
I think it is the reporting. They stress more on reporting requirements.
See, I was telling that accounting is the raw material and financial reporting is the end product.
Yes.
Product. If I may have to say, for the accountant, the finished product is the financial statement or a financial reporting. So financial reporting includes accounts. Accounts does not include financial reporting. So if I'm able to actually say that the financial reporting standards are better, which means the accounting standards are better. Other way around, let me tell you that whatever is there in financial reports is there in accounts. Whatever is there in accounts need not necessarily be there in financial reports. Let me explain this further. For example, we have an accounting standard on earning per share. Where is this particular earning per share available in accounting? When you don't find earning per share in the books of accounts, it is there only in financial statements. So like that, there could be the related party disclosures. The related party disclosures may not be there in accounts, but it will be there in financial reports. But everything which is there in accounts, the sum total of that will finally be available in financial statements. So therefore, it is better to control the final product rather than the intermittent product. So therefore, internationally, it was decided that accounting is a smaller terminology in comparison to financial reporting. And therefore, internationally, they changed the name from International Accounting Standards to International Financial Reporting Standards. Now, if you look into International Financial Reporting Standards, what does International Financial Reporting Standard consist of? It consists of international IAS 1 to IAS 41, IAS 1, IAS 2, etc., IAS 3, etc. It goes on up to IAS 41. And instead of issuing IAS 42, they started issuing IFRS 1, IFRS 2. So today, the book on IFRS, if you take up, it has about 40, out of which IAS 1, IAS 2, IAS 3. That means they did not change every name of the standard, only I always keep telling, Bombay became Mumbai, Bombay became Mumbai. I'm sure like that Trivandrum has become Thiruvananthapuram, but the airport will still be called as Bombay Airport only, or for that matter, the Bombay becoming Mumbai. The stock exchange is even today called BSE, Bombay Stock Exchange. They probably cannot change every name because it is so ingrained in our minds that the moment I say IAS 1 means I know it is a particular standard, IAS 2 means inventory, IAS 3 means cash flow statement. So like that, they never wanted to change the very root of it. But the overall, they have changed. So having said that, there are certain standards in the financial reports which are pure disclosure standards, and there are certain standards which are recognition and disclosure-based standards. So when we come to what is a disclosure-based standard, a disclosure-based standard means it will be available only in the financial statements. Whereas a recognition and a disclosure standard means it will be there in the books of accounts, and then it will also be available in the financial statements. So today I will be talking about 4 standards. One is recognition, one is borrowing cost. Borrowing cost is a recognition standard and a disclosure standard. A related party disclosure is a pure disclosure standard. Then we will talk about accounting for taxes in income, which is a recognition and a disclosure standard. And finally, I will be talking about provisions, contingent assets and contingent liabilities, which is a recognition as far as provision is concerned and a disclosure as far as provision is concerned. As far as contingent liability is concerned, it is a disclosure. And as far as contingent asset is concerned, it is not even a disclosure standard. So we will be talking about 4 standards in detail. So let me just put up my presentation, and the way we are going ahead today is not to just learn about the standards. I'm sure these 4 standards has been there. Although it is called as new generation, it has been there for the last 20 years. Nothing so new about these standards. But what is to be understood and probably experienced is to share what is the interplay between these accounting standards. Once I disclose this, what will be the implication on this on income tax, GST, or various other forums? And also to understand what is the interplay between accounting standards and ICDS. I will be touching about accounting standards and ICDS. Each of these 4 accounting standards, I will be touching upon the interplay and how does it actually impact the income tax. Point number 1. Then I will also be talking about what are the commonly made mistakes. What are the commonly made mistakes while implementing these accounting standards? So that is how we will go. So what I would like all the participants here is to put as many questions as possible. Let us share our experiences. I want you to put as many questions, not necessarily on these 4 standards. We can discuss on any standard or any matter on income tax having its interplay with the accounting standard. So that is the menu for the day. You can put your questions in the chat box, and I would request the moderator today. I'm told Praveen will be with me and also Ramesh Kumar to some extent. Whoever is there, as the organizers today, they can read out the chat at the appropriate places. What I will do is that every half an hour, I will stop at a place and I call that as a question station. At those question stations, I will ask you to raise those questions and we can discuss and debate the questions which keep coming. Any practical issue on any accounting standard, any Ind AS matter or any income tax issue, having its interplay on the accounting standards. Now, before we move forward, I know that you are on the third day. The focus of the institute this year has been to make all the chartered accountants standard accountants. I mean, why I call this is, we are all chartered accountants, of course, but they want to lay so much of emphasis this year on the accounting standards. Rightfully say, I really thank the chairman and the vice chairman of the Accounting Standards Board, MP Vijay Kumar, so who has actually been instrumental in making certain revolutionary changes in the accounting standards for non-corporate entities. I mean, accounting standards for corporate entities has been always been followed, I mean, exceptions being there. But somehow for non-corporate entities, accounting standards, although was mandatory, not for the non-corporate entities itself, but for the auditors who are auditing, who are giving an attest function or who are certifying the financial statements of the non-corporate entity, for them it is a must. So if they don't do it, discipline it, and if the matter affects the true and fairness of the financial statements, the matter can be going to the disciplinary committee also. So it is as serious as that. So they said that we have to educate all our people and ensure that the accounting standards are properly followed. And in the process, they also did one more change this year because of the change in the definition or the criteria for MSME. They made some changes in the non-corporate entities classification. I'm sure you must have gone through this, but I have my own way of telling. So I'll just, for a minute, I will spend on this. We had micro, in fact, for MSME, we have got 4 types: micro, small, and medium, and other than MSMEs. So we have large. So there are 4 categories for micro, small, and medium based on either the investment in plant and machinery and the investment in and the turnover, both put together. So like that, what we had for the accounting standards also, we had for non-corporate entities 3 levels: level 1, level 2, level 3. This year they have introduced level 4. And the criteria, unlike in the case of MSME categorization, it is not plant and machinery based, it is borrowing based. So turnover being the same. So what they did is they have taken up turnover and the borrowings, and there are other criteria which we will be looking into. For the purpose of level 1, the turnover, if the entity's turnover is more than 250 crores or the borrowing is more than 50 crores, any one of them breaching, it becomes a level 1 enterprise. Also, under the level 1 enterprise will be all those listed entities, banking, financial institutions, insurance companies, holding and subsidiary companies covered under level 1. All of them will come under level 1. Now for level 1 enterprise, all accounting standards, accounting standard 1 to 29 is mandatory. Now for level 2, level 3, level 4, which actually is a sort of level 2 will be equivalent to medium enterprise, level 3 will be equal to small enterprise, and level 4 will be equivalent to micro enterprise. Although the criteria are different, as you can see, what they did was, for medium enterprises, it is 50 to 250 crores. So there also the turnover is up to 250 crores. So here also it is 50 to 250 crores, but the borrowing is from 10 to 50 crores. And the other criteria is holding subsidiary companies covered under level 2. Then level 3, which I call it as small enterprise, will be, the turnover will be from 10 to 50 crores. Turnover will be from 10 to 50 crores with a borrowing limit of 2 to 10 crores and holding subsidiary covered under level 3. And for level 4, up to 10 crores. I mean, we may have a lot of such entities where we are auditing up to 10 crores turnover and a borrowing of up to 2 crores. So these are the 4 categorization. Now, falling in any one or more criteria, please understand when it says falling in any one or more criteria means if any one of them breaches, it goes into the higher criteria. And non-corporate entities, whether it is applicable to everybody, all non-corporate entities, the answer is if it is subject to audit, it is applicable for the auditor to ensure that the accounting standards are complied with. And if it is exempt to a non-corporate entity which does not have any commercial, industrial or business activity. If the moment the industry, the entity has a commercial, industrial or business activity, accounting standards are applicable. So how do we look at it? Turnover in the immediately preceding accounting year. In the immediately preceding accounting year, that means when I'm doing 2021, I will look into the financials of 1920 and say if in 1920 these accounts are breached, these numbers are breached, then I will have to follow these accounting standards in 2021. At any time during the immediate preceding accounting year. So at any time during the preceding accounting year, that means for the purpose of borrowing, I cannot say as at the end of the year. Anytime if I have breached 2 crores, if I have breached 2 crores, then I will fall into, and I am up to, let us say 10 crores, then I will be in level 3. So not applicable to non-corporate entities required to follow Ind AS. There could be certain non-corporate entities which are actually subsidiaries, of a company, in which context those non-corporate entities have to follow Ind AS and not the regular accounting standard. So having said that, SMCs, as far as the companies are concerned, it is called small and medium companies. We have only 2 categories there, whether for the company it is a small and medium company or a non-SMC. Who is an SMC means? An SMC, the level has not changed as far as the companies are concerned. As far as the companies are concerned, the level is the same, which is 50 crores turnover and 10 crores borrowings. 50 crores turnover and 10 crores borrowing makes it, if you are within that, you are an SMC. And if you are beyond that, you are becoming a non-SMC. For a non-SMC, there is no relaxation. Like level 1, all accounting standards are mandatory. For a non-SMC, for a regular company, all accounting standards are mandatory. So what is the legal requirement under the Companies Act? The financial statement shall give a true and fair view of the state of affairs of the company, comply with the accounting standards notified under section 133. This is as far as the company is concerned, shall be in the form or forms as may be provided for different class of companies in Schedule 3. So, this is about talking about the format, but today we are talking about compliance with accounting standards is a must as far as the companies is concerned. Otherwise, there are huge penalties and including imprisonment for the officers in default. Now, 143(3)(e), as far as the audit report is concerned, the auditor will have to report whether in his opinion the financial statement comply with the accounting standards. So he has to state this, and in case there is a non-compliance and the auditor says that everything is complied, the auditor will actually be taken to task. So audit requirements: an unqualified opinion giving referring to the following statement. In our opinion, the balance sheet, the profit and loss account, the cash flow statement dealt with by this report comply with the accounting standard referred to in section 133 of the Companies Act. So this is what was given. But from the annual report of the company, there were many non-compliances of accounting standards, but still the auditors has given a clean report, which matter can be referred to the disciplinary proceedings. So we'll have to worry about that. Whenever there is a non-compliance, of an accounting standard, the auditor has to impress upon the entity to set right the accounts and follow the accounting standards, failing which he has to qualify the accounts. And when he qualifies the accounts, it is not only a qualitative statement, qualitative statement in that sense becoming a qualification, he needs to tell the quantitative impact of his qualification. That means if a particular accounting standard 15 is not followed, maybe gratuity liability is not provided, I cannot in the audit report say gratuity liability is not provided. I will have to go to the extent of saying, if that gratuity liability were to be provided, my profits would have been lower to that extent, and my net worth would have been lower to that particular extent with a corresponding increase in the liability. So I will have to qualify and give a quantification on that particular matter. So deficiencies observed by FRRB, I'm sure all of you must have been taken through in the last 2 days, that in the institute, we have what is known as the Financial Reporting Review Board, which picks up the financial statements based on certain complaints from various maybe regulators or maybe the affected parties like banks, or on a suo motu basis, and it is thoroughly checked for compliances of technical requirements such as standards on auditing or accounting standards or Companies Act. Now, in case there are any non-compliances, the institute will refer the matter to the concerned regulator as far as the entity is concerned. But as far as the auditor is concerned, the matter will be taken up depending on whether it is a serious offense or a not so serious offense. It is not, if it is a not so serious deviation or an offense, then the matter will be, a letter will go to the chartered accountant saying that you should have avoided this, please avoid it from next time. It's sort of an advisory to him. But if the matter is serious, the matter will be referred from the Financial Reporting Review Board to the disciplinary committee. Now, this particular Financial Reporting Review Board has come out with a very good book. They come out occasionally with the findings of the non-compliances in various, with respect to various accounting standards. And they have made a compilation according to which, I would request those of you who are interested in knowing what the non-compliances are to read these publications of the institute, which is available on a soft copy basis also, and find out what you could make a mistake. If you can learn from others' mistakes, maybe you can avoid making such mistakes. So in that direction, this particular book has gone to the extent of saying which particular accounting standard has not been followed in the maximum extent. And maybe finally we'll see that the Companies Act, Schedule 3 has not been complied in a big way. And within the accounting standard 3, accounting standard 15, accounting standard 18, accounting standard 22. Maybe these are all the important standards which have not been complied with in a big way, is what they have done. In fact, within each standard, they have gone to the extent of finding out which particular paragraph has not been followed. They have gone to the extent of pinpointing to that extent. So I would recommend people to read that. Especially what I would say is, maybe in your own offices, you must have a study circle where one of the article trainees presents that and you participate and understand how the entire quality of the office itself could be improved. So with that, I come to the preliminaries. I will take up each one of the 4 standards. Now I would say that we have come to a question station. If there are any questions already posted in the chat box, I am prepared to take it up.
No, sir, there is no question.
Yeah, I would request, I know it's a Saturday afternoon where you would prefer to be resting. That is what I would also prefer to do. But then I am today with you just to enrich each other's knowledge. So in that context, the best way to enrich each other's knowledge is to post questions. So please post as many questions as possible so that we make the whatever discussions lively. So let's move to the first accounting standard 16, borrowing cost. So whenever we talk about borrowing cost, it normally we refer to interest. We refer to interest. And whenever we have to pay interest, I think this is one expenditure which we don't pay with interest. If we have to put it that way, an item which we don't pay with interest is interest. Given a chance, I would not like to pay interest. Having said that, so accounting standard deals with borrowing cost. So in one snapshot, I will try to cover the importance of this particular standard. Of all the 4 standards that I have to deal with, I would say related party disclosure is the most important one because it has got multiple repercussions. The second important standard is borrowing cost, because again it has a various repercussion, whether an item of interest has to be debited to the profit and loss account or should go into the asset side of the balance sheet. And what is its implication on income tax? How does the ICDS talk about it? So those are the things that we will be dealing with in this particular session on accounting standard 16. So first of all, we need to understand what is the meaning of borrowing cost. So let's touch base on what is borrowing cost. Borrowing costs are interests and other costs incurred by an enterprise in connection with borrowing of funds. Very simple. We know this particular thing. But the point to be noted is, what do we mean by other costs? Interest, all of us are very clear. Interest means no problem. There is absolutely no problem. Borrowing costs are interest and other costs incurred by an enterprise in connection with borrowing of funds. Now the point is whether, what do we mean by other costs? Let us talk about some examples. So examples of borrowing cost as given below includes interest charges and bank borrowings and other short-term and long-term borrowings. Very clear, no problem. Ancillary costs relating to borrowings. Now, all of you must be aware that when, let us say, your own client or yourself, you have taken a loan of 1 crore. the bank will charge upfront fee, normally 1% or 0.5% depending on the scheme. So they let us say 1%, normally they charge 1% upfront fee. So you will have to pay 1 lakh rupees. So upfront fee. Commitment charges. Commitment charges means we say, I will give you a line of credit of 10 crores, but if you don't draw, I will charge you a commitment fee of 0.65% per annum if you don't charge if you don't utilize at least 60% of the limit. I mean, State Bank of India normally tells like that. Discount or premium. I mean, if they're charging a discount or a premium, which could come in zero coupon bonds and debentures and things like that, all those things are also considered as borrowing cost. Finance charges in respect of financial leases. So leases could be of two types, financial lease and operating lease. And the finance charges arising out of finance lease is also a borrowing cost. When Accounting Standard 19 says that the finance lease should be in the books of the lessor, in the books of the lessee, that is the user of the asset, should be bifurcated. The lease rent, although I'm paying the lease rent, I have to account for interest. I have to account primarily the asset and the liability in my books. Although I'm not the legal owner, I'm not a legal owner, because the risk and reward associated with that particular asset has got transferred to me. I have to account for that particular asset and liability. And once I account for that asset, a liability in particular, I have to account for the interest on that particular liability. And as far as the asset is concerned, I have to account for the depreciation. Having said that, the interest which I am paying on account of financial lease is also considered as borrowing cost. It will not be considered in the case of an operating lease, it is considered as a lease rental. In the case of a finance lease, although the agreement may say that I have to pay a lease rental, but in the books of the accounts, I have to pass it as interest only, and that interest will be considered as borrowing cost and not any other expenditure. Next, we have another important point, exchange difference arising from foreign currency borrowings to the extent that they are regarded as an adjustment to interest cost. Praveen, are you there?
Yes, sir. I'm here.
Can you explain me what this means? Exchange difference arising from foreign currency borrowings to the extent they are regarded as an adjustment to interest cost. Ramesh Kumarji, you are able to understand this? I mean, what exactly this means? I mean, maybe your clients may be actually having a foreign currency borrowing.
Yes, sir.
Okay.
So it's like Prashant here.
Yeah. Yes.
It's like I take $10,000 US loan.
Yeah.
And on 1st of April, $10,000 US conversion rate is assumed 65 rupees.
Yeah.
And on 31st March, I have around $9,000 US liability outstanding.
Okay.
And the exchange differences say from 65, it has gone up to 69.
Yeah.
So that 4 rupees into this 9,000.
Yeah. Well, that is the foreign exchange difference. But what they are telling is, look at this. I will make a different example. Thanks, Prashant, for your interaction. I will tell you what this is, how it has to be seen from the point of view of AS16. I'm sure you must have gone through AS11. Did you go through AS11 in the last 2 days? Anyway, you must have gone through, because that's a very important standard. Having said that, you know, let us presume that I have taken a machinery loan. I have taken a loan from US. I have taken a loan from US to the extent of $1 million. And I have taken this, the forex fluctuation, forex rate was 60 rupees. 60 rupees. Now, what is the attraction for me in taking a forex loan? Always I must understand, I mean, I would have taken a loan from Indian Bank, State Bank of India, but I went to US to take a loan for the simple reason that, the interest rate in US is very, very less. When internationally, we always talk about in terms of LIBOR plus. No? So we feel that the interest rate is, I mean, it is a fact. In fact, it is so low that it could be in Japan. In Japan, we always keep telling the rate of interest would be 0.7, 0.8, 1%. When I always keep jokingly saying that here also it is 1%. But the difference is here it is 1% per month, there it is 1% per annum. So internationally, the rate of interest, let us say, internationally, I got a loan for 2.5%. I have got a loan for 2.5%. Now, this 2.5% is a great attraction to me. So I go and buy this particular, I take this particular loan. Now, when I took it, the loan, I have to repay this loan. I have to repay this loan. I have received $1 million. I have to repay $1 million. So that is the contract. So for me, the attraction is if I took this 1 million loan, which would be in Indian rupees, maybe 7.5 crores, that particular loan, I should have actually taken in, if in Indian rupees, if I took it, it would be available to me at 12.5%. Internationally, it is available at 2.5%. So that is a great attraction to me, So I would go and take this particular loan. But to my bad luck, what happens is, interest on this $1 million will be 2.5% only. But when I repay it, instead of repaying 60 rupees, which were to be, if it were 1 million were to be converted to 60 at 60 rupees, means I would have taken 6 crores. But when I have to repay it, if the dollar has gone up to 75 rupees per dollar, then I have to repay 7.5 crores. So what could have been an interest of 12% on 6 crores will now be 2.5% of 1 million plus, which is actually 2.5% of 7.5 plus this 1.5 crores extra which I have to pay. So in short, I am paying much more. If the dollars are going against me, if the dollars are the forex fluctuation is going against me, I will have to pay much more. Now the point is, how much is within this a borrowing cost? So what they say is, you do one thing, because you took it up in the forex, you are paying 2.5% interest, and difference of 1.5 crores is actually a forex fluctuation. If you had taken an Indian loan, 12.5% of the 6 crores would have been the interest. 12.5% would have been the interest. Now, therefore, they say you apply 12.5% on the 6 crores to that, although you are paying only 2.5% on that 6 crores as interest, for the purpose of borrowing cost, 12.5%, which is the Indian equivalent of the interest which you would have paid, 12.5% on the 6 crores, you consider it as interest, and the differential, you consider it as forex fluctuation and account that as under accounting standard 11. So 12.5% on 6 crores, although you are actually paying only 2.5% on the contract, but for the purpose of accounting standard 16, you use 12.5% of 6 crores as your borrowing cost. The differential has to be accounted as forex fluctuation and accounted under, as told under accounting standard 11. Is that clear, Ramesh ji?
Yes.
Now the point is, you may say everything is going to be debited to profit and loss account now. Forex fluctuation, or as the point is, there is an element of capitalization permitted. The routes for borrowing cost capitalization, the route for forex fluctuations are all different. So the differential will make an impact when you are actually preparing the financial statements. Now, this is how we need to do the remaining we have explained. Now, let me ask you certain issues. One of the points to be noted is, does not include actual or imputed cost of owner's equity, including preference share capital, which is not classified as a liability. That means, let us say I'm paying 10% dividend on a preference share capital. That 10% dividend on preference share capital is not an interest. It is, of course, a dividend. So that is a point to be noted. Let me give you an example. I will talk about one situation. Ramesh ji, since you are there, I have taken a loan from State Bank of India, 10 crores, and I'm paying interest at the rate of 10%. So naturally 10% is a borrowing cost. Now the situation is, HDFC Bank has come to me and they're telling me that they will take over this 10 crores. They will take over this 10 crores liability from State Bank of India and give me a rate of interest of 7%. So I decide to shift. But State Bank of India says, you will have to pay a prepayment penalty. You have to pay a prepayment penalty of 2%. Now the question is whether this 2% prepayment penalty is also a borrowing cost.
Yes, sir.
Is it incurred in connection with the borrowing? That is the question.
Because of the opportunity cost, no?
This question came before the expert advisory committee. This question came before the expert advisory committee. So they had to deal with this particular situation. a paragraph, when the matter come, I was a part of the expert advisory committee in 1 year, and we had to see how the matter has to be explained. It is not based on every line item, the justification based on the standard has to be considered, and the standard uses one thing. Is it in connection with the borrowing? You are borrowing 10 crores from HDFC, whereas you are repaying it with the State Bank of India. So therefore, the 2% penalty which you are paying is not in connection with the borrowing, it is rather in connection with the repayment, and therefore it is not a borrowing cost. So this is how the expert advisory committee had to opine on this particular matter. You may feel that it is so, but then the expert advisory committee has opined, and in future in such a situation we'll have to deal with that accordingly. So one is to understand meaning of borrowing cost. So we have understood what is a borrowing cost. Let's next move to understanding what is a qualifying asset. Now, why is it important to understand what is a qualifying asset? Because how do you deal with borrowing cost? Let's get into the recognition of borrowing cost before we understand what is the importance of qualifying asset. A borrowing cost, if it is in connection with the qualifying asset, has to be capitalized. Otherwise, it has to be expensed. Fortunately for accountants, we have only two statements, a balance sheet and a profit and loss account. So between these two statements itself, we have so much of confusion. Imagine, Ramesh Kumarji, if we had more statements, it would have been more confusion. But the point I'm saying is, now should I debit that particular expenditure and claim it as it is not for income tax. Let me be very clear. For income tax, the rules are different. If you see this particular chart, anything which is mentioned in red, anything which is mentioned in a red font means the ICDS has a different way of calculating all this. So let me first of all talk about accounting standards, and then I will go to ICDS. So accounting standard says if an interest or a borrowing cost has been incurred towards acquisition, construction, or production of an asset, which can be meant to be used or meant for sale, then that particular interest has to be capitalized if such an asset is a qualifying asset. If such an asset is a qualifying asset. Or that means if the asset is a qualifying asset, I can add it to the value of the asset. Otherwise, I will have to expense it. Now, my question to you is whether it is good to expense or good to capitalize, sir? Is it good to expense or good to capitalize? Given a choice, if the standard were not to be there, what you would have done? Now look at this.
Yes.
Look at this. We need to always understand the objective of the standard. Objective of the standard is it now. If I were not to have this particular standard, my way of treating this expenditure would depend on what I want. Suppose in a particular year I want to have less profits, I would have capitalized it. I would have expensed it. I would have expensed it. If I wanted to have more profit, I would have capitalized it. So look at this. I would deal in a manner that is suiting me. So therefore, to remove this particular objective-based, calculation, the standards have come into play where they reduce the options available to me and tell me this is what you have to do. This is what you have to do. So if your borrowing cost is in relation to acquisition, construction, or production of a qualifying asset, then that alone can be capitalized. Everything else has to be expensed. So now, therefore, we have to understand what is a qualifying asset. What is a qualifying asset? A qualifying asset is an asset that necessarily takes substantial period of time for it to get ready for its intended use or sale. Now, what do you mean by substantial period of time? Now, substantial period of time has been told in the standard as, normally it is 12 months. However, a lower than 12 months is also taken into account, but for all audit purposes, we are taking 12 months and above. Could be shorter or longer based on facts and circumstances of each case. Very, very rare. Estimation of time based on the time when asset takes technologically and commercially to get ready for its intended use or sale. That means when I'm estimating, if I'm estimating that it takes 13 months, then I will consider it as a qualifying asset. The actual period of construction could be completed in 10 months. So my way of finding out a qualifying asset is at the time of estimating how much time will it normally take. Does it take more than 12 months? If the answer is yes, then if I have taken a loan on that, the interest associated with that loan has to be added to the value of the asset. That is what we say capitalization. Has to be added to that value of the asset instead of debiting it to that particular expense account. So that is how it is. So qualifying asset is an asset that necessarily takes substantial period of time to get ready for its intended use or sale. Assets that are ready for intended use when acquired are not qualifying asset. Now suppose I bought a building. I mean, I have purchased a building, but I am not able to get the tenant still. I am not able to get the tenant still. And I have taken a loan and I am paying interest on that. Can I add it to the value of the building? The answer is a big no, because the building is already ready. There is no question of it being called as a qualifying asset. It would have taken more than 12 months for the builder to build it. But from your point of view, you have already purchased it and it is ready. It's ready for its intended use. So therefore, we cannot talk about that as a capitalization situation. So qualifying asset, we have seen the meaning. What are the examples? What could be the examples of qualifying asset? If you take a building under construction, a machinery under construction, which will take more than 12 months. A machinery under construction. I mean, I know Cochin, we had that big ship which was under construction. So that ship or an aeroplane, any asset which takes more than 12 months for it to get ready for its intended use or for its sale is considered as a qualifying asset. So the meaning, the examples could be ships. I mean, now let's talk about can inventories be qualifying asset? That means I talked about capital assets. Can inventories be capital asset? The answer is a big yes. And inventories also. Let us say I am a builder. I am constructing my buildings, and that building is eventually going to be sold. So therefore, the building under construction could also be a qualifying. It could be inventories to me. It could be inventories to be, not property, plant and equipment. It could be inventories, and those things are also considered as qualifying asset. The other things, popular qualifying assets which come under inventories could be wine, timber. I mean, which takes seasoning. Seasoning is a must for all of them, and it gains value through the seasoning. So therefore, those could also be examples. What could be excluded is that, I mean, we have already seen that which is ready at the time of purchase for its intended use is not a qualifying asset. We have also seen what is a substantial period of time, normally 12 months. Now, recognition. How do you recognize this? We have already seen. Please understand what is meant by recognition. Recognition means what is a journal entry you pass in the books of accounts, whether it goes to the expense account or does it go to the capital side of the balance sheet, I mean asset side of the balance sheet. So recognition, capitalized. The borrowing costs are capitalized if it is attributable to. If it is attributable to, so how do you recognize a borrowing cost? Borrowing cost directly attributable to the acquisition, construction or production of a qualifying asset should be capitalized. Please understand, it is not an option. Even if you want to take it to the profit and loss account, you cannot take, but you will have to capitalize it. Should be capitalized if and only if qualifying asset will result in future economic benefits to the enterprise and costs can be measured reliably. Now, please understand that qualifying asset will result. Suppose you have incurred a borrowing cost and you are not sure of the qualifying asset's value getting appreciated to that extent, then you will have to debit it to your profit and loss account. Okay, qualifying asset will result in future economic benefits to the enterprise and the costs can be measured reliably. After capitalization, look at this. After capitalization, impairment test is required. Let us say I have taken a loan of 10 crores and I'm constructing a building worth 10 crores. I have constructed 10 crores worth of building and the interest on this particular 10 crores borrowing has come to 2 crores over a period of 2 years. So now I'm going to add this 2 crores to the building cost. So the total building cost will be now 12 crores. Total building cost will be 12 crores. So suppose I do, if I have to sell, I mean, an impairment test under accounting standard 28 says value in use I mean, I have to compare the carrying value of 12 crores with the value in use or net selling price. Okay, whichever is higher. I presume that I don't have a use for that, and my net selling price is only 11 crores. Only 11 crores. Then actually I have added my interest more to this extent. That means I have added inefficiencies to this particular building, so that additional difference between 12 crores and 11 crores, which is actually 1 crore, has to be debited back to the profit and loss account as impairment, as impairment. Other borrowing costs we have seen. Borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset should be capitalized, given this condition. Other borrowing costs should be recognized as an expense in the period in which they are incurred. So this is the criteria with respect to recognition. Now, conditions for capitalization. Conditions for capitalization is that particular asset for which you are capitalizing should give you a future economic benefits. That particular asset should give you a future economic benefit, and you should be able to measure that economic benefit reliably. So we have already seen this. Otherwise treated as expenses if conditions for capitalization is not met. So we are very clear what the preliminaries are, what the recognition criteria are. The treatment of interest. Now, how do you treat? Now, you have paid interest on loans. Depends on whether the loan is taken specifically for that asset, or you have taken a general purpose loan and you are using it for various assets. So there they say treatment of interest if the loan is taken for a specific borrowing for constructing of a building only. Actual borrowing cost less interest on temporary amounts of borrowings should be added to that particular asset. That is a point to be noted. If I have taken a general borrowing, let us say I have taken a 10 crores asset-based loan. I have taken a 10 crores asset-based loan, and I am constructing a building worth 5 crores. And the balance 5 crores, I am actually using it for my general working capital purposes. Working capital purposes. Now, how do I allocate this general borrowing to a specific asset is the question. So there they say you work out a weighted average capitalization rate of the general borrowing. So rate of interest divided by general borrowing, that is the rate, and split it based on this borrowing, how much you have split it between various assets. So depending on that, you make a apportionment and do the calculation. So amount, I mean, all these things have been specifically worked out and given in the standards. I mean, I'm not getting into the detailed workings today. Amount capitalized should not exceed actuals and after deducting interest income, if any. Now, this is a very important thing. Suppose I have taken a 10 crore loan and the bank has released the entire 10 crores and I have used only 2 crores initially. 8 crores I had surplus money. What I have to do is I kept this 8 crores in another bank and earned some FD. So finally, when I calculate my borrowing cost, it should be net of the interest income earned on such surplus deposits kept for a parked in temporarily. So that is how accounting standard says. Whereas the ICDS here itself, I will tell you, ICDS does not permit this. ICDS says your interest expenditure only can be capitalized as per ICDS, and interest income earned on temporary withdrawals out of the surplus money, surplus loan, if you have parked it and earned something, that has to be offered as income separately under income from other sources. Next, capitalization principles. Commencement of capitalization, including expenditure, including borrowing cost and qualifying asset being incurred. So when can you start capitalization? So that is the point that is being told. So commencement of capitalization. Capitalization of borrowing cost should commence if all the following 3 conditions are satisfied. Point number 1, expenditure for acquisition, construction, or production of qualifying asset is being incurred. So first of all, it should be a qualifying asset, which will take more than 12 months period. And I'm incurring the borrowing cost. I mean, I have taken a loan, I'm incurring the borrowing cost. The construction is under progress. Expenditure for acquisition, construction, or production of a qualifying asset is being incurred. And activities that are necessarily to prepare the asset for its intended use or sale are in progress. So, I mean, the expenditure towards the build-up of the qualifying asset is there. Interest is being incurred. Activities are on that particular thing. All the 3 should be present for the capitalization to commence. Capitalization to commence. Then with the next point we have to see is up to what date? I mean, it is not throughout the life of the building that I have to capitalize. The moment the building is ready for its intended use or sale, I should stop. That is called a cessation. let me finish off cessation and then come to suspension. When I should stop capitalization. So if the building is taking 2 years for it to complete, what I will do is the moment 2 years gets over and when the building gets completed, I will, from that day onwards, I will not add it to the asset value. From that day onwards, it becomes a interest which has to be claimed in my profit and loss account. So that is about cessation of capitalization. Cessation of capitalization. Now the other question that comes out is, what if the projects are divisible and which can be used independently? Let us say I'm constructing a two-tower project, Tower A and Tower B. If Tower A is ready, and can be used independently, can be sold independently, I will not wait for Tower B also to be ready for it to stop capitalization. So that is what is meant by cessation of capitalization for divisible and indivisible projects. Then is something called the suspension of capitalization. So normally 2 years it should take. 2 years it should take. 1 year I have started completing and I have done all the works. It is going on smoothly. But after 1 year, because of COVID or because of lockdown or because of labor strike or something, the project was suspended. When after 1 year, the building is still not ready, the project got suspended. Suspended means it is for 3-4 months, I could not carry out the work. After 4 months, again I started. So what should have been a 2 year period became finally 2 year and 4 months period. So this period, abnormal period of suspension, will the interest stop? The interest will not stop, obviously. The interest which is paid during this abnormal period of suspension the capitalization should be suspended. The capitalization cannot happen during this particular period of abnormal suspension. But let me also give you an example. If it were to be a normal suspension, when we are constructing a building, we know that every day we cannot carry on the work. Maybe after a particular centering work and I'm putting the concrete, maybe if 21 days no work is being done because it has to heal or whatever. Now that normal period of suspension need not be considered for not expensing it. But abnormal period of suspension must be considered for the purpose of suspending the capitalization of expenses. Then last, foreign currency loans we have already dealt. What are the disclosures to be made? Disclosures are accounting policy. How did I account for the borrowing cost? And what is the amount of borrowing cost? What is the amount of borrowing cost? So let's get into the suspension of borrowing cost. During extended periods other than normal temporary delay in which active development is interrupted, that is called suspension. An entity does not normally suspend capitalizing borrowing during a period when it carries out a substantial technical and administrative work. So, I mean, if it is carrying out some technical or administrative work, the actual construction has stopped, but I'm doing some technical or administrative work means I can still continue with the capitalization. Capitalization can start when the work is resumed. So that is how we have to understand. So cessation of capitalization of borrowing cost means when do I stop capitalizing the borrowing cost? When substantially all activities necessary to prepare the qualifying asset for its intended use or sale are complete. Okay, when everything is complete, I have to stop capitalizing from that particular. It need not be 2 years. If it has completed, although I budgeted for 2 years, but actually I completed it in 18 months. Then only for 18 months I can do the capitalization. After it is ready for use, although I had originally budgeted for 2 years, but now it is ready for use sooner. Or in the opposite situation, I have budgeted for 2 years, but actually it took for 2.5 years. In that context, up to 2.5 years, you can continue capitalization, provided you do the test of impairment. So when substantially all activities necessary to prepare the qualifying asset for its intended use or sale are complete, an asset is normally ready when its physical construction is complete, even if routine administrative work might still continue. The building is ready. You did not get the occupancy certificate. So therefore you said that no, occupancy certificate is still not got. So therefore building is not ready is not the answer. The building is ready. Occupancy certificate from the municipal corporation is taking more time. So you should not wait for that to come to call it as closed. The moment the activity is closed, the cessation of capitalization should happen. If minor modification, such as decoration of property to user's specification is only pending, it means that substantially all activities are completed. So the word substantially is important, not all activities, substantially all activities. For that part which is completed and is capable of being used separately. We have already seen, is the project divisible or non-divisible? If the project is not divisible, then entirely, let us say I have a factory which I am constructing which needs all, and I have got different buildings. I have a storehouse, I have a process A, I have that, this. So different things, I cannot start using different things by itself until all of it is ready. So then till all of them is ready, all of them are ready, I cannot stop capitalization. So what is the disclosure that I have to make? The financial statement should disclose the accounting policy adopted for borrowing cost and the amount of borrowing cost capitalized during the year. What is that because interest is available in the profit and loss account. How much of interest was actually not debited to profit and loss account but has actually been debited to the asset has to be specifically disclosed. Now, how does an accounting policy on borrowing cost normally look like in the financial statement? The normal accounting policy which we give, borrowing costs that are attributable to the acquisition or construction of a qualifying asset. When you will see that, when I talk about the normal non-compliances that are being used, we have seen some of the financial statements saying borrowing costs that are attributable to the acquisition or construction of a property, plant and equipment or of a fixed asset are capitalized. If you use the word fixed asset, then please understand, if the fixed asset has taken only 6 months or 7 months for you to construct, 7 months to construct, then you cannot capitalize the interest on such an asset. It is only if that fixed asset becomes a qualifying asset, only then, and it becomes a qualifying asset when it takes more than 12 months for you to complete that particular asset, then you can capitalize it. So if you use the word fixed asset, then maybe you are wrong. So therefore we wanted the particular word to be used as qualifying asset or capitalized as a part of the cost of such asset till such time as the asset is ready for its intended use. A qualifying asset is one that necessarily takes substantial period of time to get ready for its intended use. All other borrowing costs are charged to the profit and loss account. Now, same disclosure is required even in ICDS 9, but maybe the accounting policy write-up will be different. So what are the major changes with respect to ICDS 9? Capitalized borrowing cost on fixed assets, even if it is not more than 12 months. Now, in income tax, we know section 36(1)(3) was always there. And there was also section 43A, which also goes on to say the same thing, that an asset, if you are taking if you are making interest on an asset which is under construction, till the date the asset is put to use, I will not allow you the interest. Rather, that interest has to be added to the cost of the asset and you can claim depreciation if you are eligible to. So that is how the income tax says. So let us make an example, and same thing is now reiterated in ICDS. So in short, if I'm taking only 7 months to construct a building or a machinery, then under accounting standards, that should be considered as an expense, but under ICDS and income tax, it should be capitalized to that particular asset. So to that extent, there is a difference. Now, I also told you about the suspension of capitalization during extended period. Now, if there is a temporary lockdown or a strike or some reason because of which you are not able to carry out the work, which was abnormal, not the normal ones, 4 months you could not carry out the work. And in some cases, we have seen for 4 years also, they have not carried out the work. So in that period of stoppage, temporary stoppage, accounting standard says you will have to claim it as an expenditure, not capitalize it. But ICDS says that particular thing should continue to be capitalized. Until the asset is put to use, it will be capitalized only. The third point we have already seen, borrowing cost on funds, general borrowing fourth point we have seen, borrowing cost on funds, general borrowing as per formula given in ICDS. There is a small change in the formula between accounting standards and ICDS when it comes to general borrowings. I'm not going to talk about it today, but you can do the calculations. Then income from temporary use of unutilized borrowed funds. We already seen this is deducted from borrowing cost as per AS 16, but under ICDS, it is subject to tax in the same year separately. So only the interest paid is capitalized, interest earned is taxed separately. So that is how it has to be seen. There is some minor conflict today. I'm not talking about that. Now, what are the practical issues? Yeah, this is where I want each one of you to be involved. I think the first point we have already seen. Can prepayment penalty charges paid to a bank for taker of a loan from a new bank be considered as borrowing cost? The answer is no, as told by the expert advisory committee. The second point, Rameshji, can fees paid on resetting of interest liability be considered as a premium or discount related to borrowings? So what does that mean? State Bank of India now gives me an option. I would have normally taken a loan, housing loans we know. I have taken a housing loan or a corporate loan also under a fixed interest scheme. That means today you have a floating interest scheme and a fixed interest scheme. That means whatever is the rate externally, I will give it to you at 10%. I would have taken, because then it would have been 11 or 12% if I had gone there. Then now the rate of interest is favorable to me. So State Bank of India comes and tells me, you break it up from fixed interest scheme and come to floating interest scheme, but you will have to pay me 1.5% now as a penalty. And then you can move to the flexible interest scheme, in which case it will become 7% to you in State Bank of India itself. So this 1.5% what I paid to State Bank of India, will it be considered as borrowing cost?
I think it's yes.
Again, the answer is no. Again, the answer is no. They said that it is not a premium or discount related to borrowing. In that sense, it is not a fresh borrowing in that particular sense. It is an existing borrowing which continues. So therefore, we will not allow you. So in short, our institute, or for that matter, accounting standards are against capitalization. You must understand this. They are against capitalization. Whereas ICDS is very much in favor of capitalization. You see the fundamental difference between ICDS and our accounting standards. Our accounting standard says, I don't mind if you put it to profit and loss account. Sir, the best thing is the profit and loss account. I would like to use one very interesting terminology here. Profit and loss account debit side. Profit and loss account debit side is called the burial ground of the company. Why, sir? Because any expenditure, the benefit of which has got expired, is buried in the debit side of profit and loss account. So therefore, the profit and loss account debit side is very beautifully called as the burial ground of the company. Now, I don't mind you burying the expenditure, but the moment you put it under the capital asset, if you are capitalizing certain expenditure which are not worthwhile, it increases your net worth unnecessarily in some times. So they don't want that unnecessary inflation of your net worth and your valuations, because accountants are conservative, prudent, and things like that. Whereas income tax goes on a different level. So there it is a different. So this particular answer to question number 2 is also no. Can borrowing costs during trial runs be capitalized? Now, whatever interest cost paid, let us say I am ready with the machinery or the ship or whatever. Okay. And I am doing a 3 months trial run production. Can it be capitalized?
Yes. Yes.
Now there the answer is, if the trial run is normal, if the trial run is normal, up to that normal period, you can capitalize. But if it is abnormal, then you should stop it at that particular normal situation. The next point is loan taken for purchase of inventory. Can interest on loan be added to inventory?
Yes, in the case of builder, as you said.
Yes, exactly. So if not on all inventory you can add, that inventory should also be a qualifying asset. Please understand, a qualifying asset definition could include an inventory. Yes or no, sir? A qualifying asset is not only a fixed asset or a property, plant and equipment, even an inventory. Therefore, let me go back to my definition of qualifying asset. Now here it is said, qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended sale. If it is for its intended sale, means that is the inventory. So a qualifying asset could also be an inventory. And if that takes a substantial period of time, then and only then you can add it to the value of inventory. Can interest on loan taken to purchase land be capitalized until the building is constructed? So I have got a land and I'm going to construct a building, and I have taken a loan for both land and I will also take a release of the land when I'm going to construct. Can I does it fall into the picture of land is ready for its intended use? Can I say that no, it cannot be capitalized? Now here, there a point to be noted is it can be capitalized provided. So this is where is this is the point when you'll have to use that. For capitalizing the interest on the land, 3 conditions should be incurred. Expenditure for acquisition, construction, or production of a qualifying asset is being incurred. Are you incurring, sir? When you purchase the land and where you have told that you will construct a building, are you incurring? Here, the point is, I will have to now refine. If there is a substantial gap between purchase of land and construction of building, then I am afraid the first condition itself is lost. The expenditure for acquisition, construction is being incurred. It is not being incurred. The building cost, I am purchasing the land in year 1, and in year 4, I am constructing the building. In year 4, I am constructing the building. Then although the land does not have an independent use until the building is ready, I cannot say until the building is constructed, I will capitalize. The answer is no. For accounting purpose, I'm very clear that the cost of the land, if the building is not in motion, the construction is not being incurred, then I cannot capitalize. However, now I'll come back. If I have purchased the land in month 1 and in month 2, month 3, I'm doing some land planning, building approval and all this stuff. In month 3, I have started construction. Then first condition is yes. Borrowing costs are being incurred. I have taken a loan, therefore I am paying interest. Then activities that are necessary to prepare the assets for its intended use or sale are in progress. That means a lot of activities. One is expenditure, one is activity. Okay, activity means there should be some construction activity happening. So all those things, 3 things are happening. So the answer to question number 5 is a conditional answer. If the land is incurred and the building is not happening, then I cannot. If the land is incurred and the building activity and the expenditure is being incurred, then I can do the capitalization. So what are the various mistakes? What are the various mistakes pointed out by the FRRB? Borrowing, I call that as accounting substandards. You'll have to be a standard person. If you are not doing that, then you are a substandard. So in the accounting policy, somebody has written like this: borrowing costs are capitalized if capitalization criteria is met. You may know, you may do it properly, but you will have to also make the other person know what is that particular criteria. Somewhere if you say that the company has complied with all accounting standards as prescribed, one accounting policy, if you give, that will not be sufficient. You will have to be very, very detailed in your accounting policy disclosure. Point number 2, borrowing costs directly attributable to acquisition or construction of a qualifying asset are capitalized as part of the cost to the assets up to the date the assets are put to use. Now, here this is what other borrowing costs are charged to profit. The mistake is up to the date the assets are put to use means maybe it would have been ready earlier. Up to the date it is ready for use. I would have stretched it because like I told you the example of the building was could not be used because the occupation certificate was not ready, electricity connection was not there. That was independent. You could have started using the building. So your inefficiencies cannot make the building cost higher. So that is the point. If it is ready for use, that is the stage where the capitalization should stop. So these wordings go to say that although it is ready for use, subsequent to its time also you have capitalized. That is the point. That was mistake found out by FRRB. Though the accounting policy on borrowing cost has been disclosed, the amount of borrowing cost capitalized during the period has not been disclosed. Now, if you see the disclosure, we have already seen not only the accounting policy, the amount of borrowing cost capitalized during the period has to be disclosed. That was not disclosed. So that was a mistake that was found out. Fixed assets are stated. Today, please note that we cannot use the word fixed assets anymore. It has to be property, plant and equipment. Ramesh Kumar ji, why did they change from fixed asset to property, plant and equipment?
Right.
I always want to know the why of it rather than the what of it or how of it. Okay. Now, sir, this mobile phone, will you treat it as a capital asset for the purpose of accounting? Let us say I paid 1.5 lakhs for this. Is it a capital asset or will it be written off in my books of accounts?
Capital asset. No.
It has to be capital asset. Now, under what heading, sir? Is it a fixed asset or what? It has to be naturally a fixed asset. When we put this particular thing under fixed asset, the non-finance people felt that it is not fixed. No? You see this? It is not.
Yeah.
So they thought that fixed asset means only land and building. Only land and building. So to that extent, fixed asset was considered to be a misnomer. So hence the change to property, which means immovable property. Plant means, of course, it could be plant and machinery or plant and trees in that sense. When the person must have dealt with even plants can also be property, plant and equipments, of course, equipments. So this is a equipment in that sense, or whatever you can say. So property, plant and equipment. So today we cannot use the word fixed asset in our financial statement. It has to be property, plant and equipment. Fixed assets are stating at cost less accumulated depreciation and accumulated impairment losses, if any. Cost comprises of purchase price and other directly attributable costs of bringing the asset to its working condition for its intended use, and includes interest on money borrowed for construction or acquisition of fixed assets up to the period the assets are ready for use. So includes the money borrowed for construction or acquisition of fixed assets. I think that is where, again, the word should not have been fixed asset, it should have been qualifying asset. So that is a mistake that was pointed out. Now, borrowing cost, fifth point, borrowing cost includes interest, amortization, ancillary, etc., etc. Cost in connection with borrowing of funds to the extent not directly related to the acquisition of qualifying asset are charged to the statement of profit and loss account over the tenure of loan. I mean, this is they did not like the word over the tenure of the loan. So it has to be as and when it is due, and that has to be capitalized, and depending whether it has the ability to capitalize, you should have capitalized it. Point number 6, borrowing costs attributable to fixed assets during construction, renovation and modernization are capitalized. Such borrowing costs are apportioned on the average balance of capital work in progress for the year. So it should have been a weighted average cost rather than because a word average does not mean whether it is weighted average. That was the mistake that was pointed out. So that gets us to the end of borrowing cost 16. If there are any questions, I am prepared to take them.
Chat box, it's there, sir. In the chat box, some questions are there.
Yeah, Prashant or Praveen, can you read it out? I will.
In the case of interest accrued on the account of diversion of funds to associate concerns, is a separate disclosure is required.
Now, see, now Schedule 3 wants you to disclose diversion of funds. Okay? So otherwise, accounting standards, we don't need that.
If there is a specific and another general loan and both have different interests, how do we capitalize such costs?
Fantastic. So what you will have to do is, you have taken 2 loans and 2 loans have different rate of interest. And now you'll have to see whether these 2 loans are used for one particular asset or various assets. Now, if these 2 loans are used for one particular asset, no problem. The entire interest for that can be added to that particular asset. There are 2 loans. First of all, do is I will find out what is the total interest paid by multiplying the rate with the loan amount and period of usage. I will work out what is the interest that I have to pay for the whole year and what I have actually paid, because it is not a prospective calculation. It is a backward calculation. What is the total interest that I have paid? Now, and divided by the total borrowing, that will give me the rate. This borrowing, how have I utilized against various assets? So that weight based on which I have to apportion this particular interest.
If the acquisition and borrowing occurred in mid of the year and construction not completed by the end of the reporting period, what should be the treatment of interest?
Very good question. See, it is not, I mean, always it happens not at the beginning of the year. I mean, very rarely it coincides with the beginning of the year. Construction starts somewhere in middle only. But what I have to do is whether my construction period will be more than 1 year. It may fall in or 3 years or whatever. If the answer is yes, and from in the first year, whatever interest I have paid on the loan, which I have used for the purpose of constructing that particular asset, has to be added to the value of that particular asset. If the answer is no, means if the period taken is only 7 months and I have started it in let us say January, so 3 months have got completed in year 1, then I will say that in the next 4 months it will be done. So therefore the 3 months interest will be debited to profit and loss account, and 4 months interest in the next year will be debited to the profit and loss account of next year. But let us say I have started this work in January and it will go on for 18 months. Then for the first 3 months, because I have started it only in January, February, March, whatever interest I paid will be added to the cost of that particular, will be capitalized to that particular asset, added to the cost of the asset.
So if interest expense is incurred on a substantial repair or renovation, can it be recognized as borrowing cost?
That's a very good question. Now, whether substantial repair or renovation itself fits into the definition of property, plant and equipment. Accounting standard 10, we'll have to go to first accounting standard 10. If the repair is substantial, renovation is substantial, what accounting standard 10 says is, I can take that value of the asset into my books of accounts. Let me take the example of normally we used to say a lift which is replaced in a hotel. When I am replacing a lift in the hotel, when accounting standard 10, old accounting standard 10 before 2016, we used to say that there is no change in the operating efficiency. When the tire, if I have just replaced the tire, it is only a old tire and a new tire. So therefore, it should be actually expensed. And all the costs which are going to be incurred only to replace and not add any economic benefit to the entity has to be expensed. So this is what accounting standard 10 up to 2016 was. So from 1/4/2016, accounting standard 10 says anything which adds, if you are replacing a property, plant and equipment, the cost of the new property, plant and equipment, if the PPE takes more than 12 months, if the new PPE takes more than 12 months, has to be capitalized. And the carrying cost of the earlier property, plant and equipment has to be de-recognized in the books of accounts. That means has to be removed from the gross block and the net block. Okay. So if by virtue of this, if this repair is, by what you are saying, it is substantial and therefore it is going to be capitalized, then I will go to the next test. Yes, it is a capital asset. And will that particular, have you taken a loan for that and incurring a borrowing cost? And this particular renovation work is going to take substantial period of time. If the answer to all of them is yes, then the interest also on such an asset can be capitalized.
Sir, if interest is charged to P&L account, assuming interest recovered is less than 12 months, and what if actual time taken is more than 12 months?
Yeah, that's a very good question. Then also the answer will not change. You have estimated it to be completed in 7 months and actually it happened to be 15 months or 14 months. Then I'm afraid extension is on account of some inefficiency, some inefficiency, and inefficiencies cannot be capitalized. So therefore you go with the expensing only and not capitalizing it.
Okay, sir. So
yeah. Shall we move to the next one? Accounting standard 18. A very, very dangerous thing because it could have a lot of ramifications once you disclose. It is a very simple standard. You will have to disclose the transactions with the related party whenever there is a transaction. However, if the related party happens to be a party where control exists, or you are controlling. That means control exists. Maybe I am controlled or I am controlling. In that context, I have to disclose whether or not transactions are there. Very simple. So related party disclosure means disclosing the transactions with related parties wherever the transactions are there. Point number one. Point number two, whether or not transactions are there, I have to disclose the name of the related parties whom I am controlling or whom I am being controlled with. That's it, as simple as that. Now, why this particular disclosure? Normally, related parties are having, I mean, if there are any transactions with related parties, the regulators or the other stakeholders would like to know whether it is done at an arm's length, whether they have suffered on account of, whether they have suffered. The income tax department would like to know. But because the company has paid more to the managing director or to the wife of the managing director, salaries, etc., the income tax which would have otherwise come from the company has got reduced. So there will be a lot of stakeholders like the bonus to the employees or to the income tax or to other shareholders. They may feel that the related parties are enriching themselves at the cost of the other shareholders. So all these disclosures is a matter of good corporate governance. Now, earlier it was, I mean, like what Jomon K. George said, that before 2000, all these were not regulated. Now they say, earlier it was only good corporate governance. Now it is a statutory requirement for the entities to talk about related party disclosures. Now, before I talk about related party disclosures, I had forgotten one thing under the borrowing cost. Borrowing costs are, the standard is applicable to all the levels of entities, all the entities, all type of entities, whether it is SMC, non-SMC, because it is a recognition-based standard. Now, for related party transactions, for related party disclosures, first of all, let me finish it off. It is applicable to level 1 and level 2 entities only. Level 3 and level 4 entities are exempt from disclosing the related parties. And as far as companies are concerned, it is applicable to all companies, including including SMCs. Including a small and medium company has to disclose the related party transactions. So that's the first thing to be noticed. So normally, in all the accounting standards, if it is a recognition-based standards, exemptions are not given. It is applicable to everybody. Whereas if it is a disclosure standard, some relaxations are given with respect to disclosure. Since related party disclosure is a pure disclosure standard, relaxation has been given to level 3 and level 4 entities, not to companies. Companies, everybody has to follow this. So very, very simple. First of all, we need to understand who is a related party. Control aspect, we know when a control is going to be there, we will see that. And then who is an associate or a joint venture? An associate means if I have invested something in the other entity more than 20%, less than 50%, then he is my associate. Joint venture means where entities come together and jointly control the operations, then it becomes a joint venture. Then related party could be on account of ownership and their relatives. Related parties, key managerial personnel and their relatives are also considered to be related parties. And related party is also available, is also there whenever there is a significant influence. So each one of them we are going to see. So first of all, let me understand who is a related party. How does the accounting standard defines related parties in two ways. One is very general, and one they come and say sort of, they give us a direction as to how to ascertain a related party situation. So let's talk about general. Generally, they say related party means parties are considered to be related if at any time during the reporting period, one party has the ability to control the other party or exercise a significant influence over the other party in making financial and or operating decisions. So one could be on account of control, the other one is on account of exercising significant influence. So when do I see this? I mean, this is general definition. Let me come to the specifics. The specifically I have been given, what should I say, hints to find out how, when, who and all are considered to be related parties. There are 5 types of related parties as told in Accounting Standard 18. Point number 1, either party has the ability to control the other party or are under the common control That means I am a holding company and the other one is a subsidiary company. I am a holding company and the other one is a subsidiary company, then I am controlling, I am also a control. So both of us are related by virtue of control. The other situation could be both of us are subsidiaries of one company. Both of us are subsidiary of one company and we both are connected because we have a common controller. We have a common controller. That type of relationship. Now, Prashant, you will be able to appreciate if company H has invested in S1, company H has also invested in S2. The relationship between H and S1 is control. The relationship between H and S2 is control. What is the relationship between S1 and S2? Prashant, can you answer? What is the relationship between S1 and S2?
Common control.
One is to say common control. The other technical way is to say they are fellow subsidiaries. They are fellow subsidiaries. By virtue of common control, they are considered as fellow subsidiaries. So either party has the ability to control the other party, or both of them are under the common control in making financial or operating decisions. So how do you arrive at control? Ownership is more than 50% of the voting power. Ownership is more than 50% of the voting power. And control of composition of the board of directors. It could be, one is to say I am controlling more, I am owning more than 50%. The other one is I am having less than 50%, but I am controlling the entire board. Then also I am supposed to be controlling. Then the third situation is I am having less than 50%, more than 20%, 20 to 50% substantial interest in the voting power and the power to direct a financial or operating policies. You look at this. If the company is so widely scattered, that not one of them is holding more than 50%, but a person who is holding majority, let us say 30% I am holding, everybody else is holding less than 5%. I am holding 30%, by virtue of which I am controlling the entire operations and the financial policies of the company. In that context, although I don't own more than 50%, I don't control the board of directors, I am having substantial interest, that is more than 20%, and the power to direct financial or operating policy, then I am said to be having the entire control on the company. The question number 2 is associates, joint ventures, or investing party or venturer. You know associates. Associates, Prashant, means if I have invested more than 20% in, let us say, a company H, let us say a company A, let me use the example of company A. Company A has invested 25% in company B. Then company B is said to be an associate of company A. What is company A? What is company A? Company A, earlier we thought it was an associate, but it is actually called as the investing party or the venturer. This investing party or venturer definition was always there, international accounting standards, in accounting standards. Now they introduced this definition in Companies Amendment Act 2017 onwards. So associates, joint ventures, we know, joint operations done by two people is called joint ventures. So that if the relationship between associates, investing party and joint ventures is also considered to be a related relationship. Point number 3, individuals having control or significant influence and their relatives. So people who are having control, the individuals having control or who are exercising significant influence and their relatives are also considered to be related parties. The fourth type is key managerial personnel and their relatives. Key managerial personnel and their relatives. And the fifth type is either party exercises significant influence on other parties. When either party exercises significant influence. None of the first four, but I am holding more than 25%, as I told you. Or, I mean, that would come under associates. I mean, I am holding less than 20%, but then I am having an agreement by virtue of which I am exercising significant influence on the other party. Then also it is said to be a case of related party. But how do I ensure significant influence is there? That directions have been given in the standard. Participating in the financial or operating policy decisions without control through ownership. It could be through ownership or through statute or through agreement or through agreements. Then how do I presume that there is a significant influence? By representation in the board of directors, participating in the policy making process, material intercompany transactions, interchange of managerial personnel or dependence on technical information. So this is a one slide which is very important for us to understand when the parties are said to be related to each other. There could be an element of subjectivity involved here. The company may say that we are not related, but an auditor will have to probably point it out. So we have to get the understanding of the situation from the company and report the related parties. So related parties, I have told you, control, joint associates, ownership, KMP, or significant influence. Now, who are, let's go to the various definitions. Related party transactions. Now, related party transactions, sometimes the transactions would be done, but no charge would be levied. Even that is considered as a related party transactions. So please be aware, related party transaction means transfer of resources or obligations between related parties, regardless of whether or not a price is charged. Regardless of whether a price is charged or not, it is considered to be a related party transaction. That means if I have sent my employees on deputation to a subsidiary company, I am paying the entire salary, but I have sent them. So there is a movement of the resources from my holding company to the associate company. There is no payment made by the subsidiary company, but then even then that is considered as a resource or an obligation transferred without charging a price to the subsidiary company is considered as a related party transaction. Control, we have already seen. Control, we have already seen different contexts. So we have understood what is control. Significant influence also I have shown what is significant influence by this. Then associates, we understood joint ventures, joint control. Next, let us understand what is a key managerial personnel. Now, if you look at the definition of key managerial personnel in accounting standards, they have very broadly defined who is a key managerial personnel, as opposed to the definition of a key managerial personnel in Companies Act. Now let's see what is the accounting standard definition of key managerial person. Those persons who have the authority and responsibility for planning, directing, and controlling the activities of the reporting enterprise are called KMPs. So they should, if they have the authority and responsibility for planning, directing, and controlling the activities, then they are called KMPs. Then they have gone to the extent of taking the examples. In a company, the managing director, whole-time director, manager, and any person in accordance with whose direction or instructions the board is accustomed to act are usually considered as KMPs. So normally in a company, a managing director, a whole-time director, and a manager, and any other person in accordance with whose direction or instruction board is accustomed. In fact, any other person is left open. But if you come to the definition of KMP in the Companies Act, Section 2, subsection 51 defines KMP as a CEO, managing director, manager. Maybe all of them are also considered to be director, KMP, even in the company, even for accounting standards. Company secretary, look at this. A company secretary, a CFO, is considered as KMPs in the case of a company, but in the case of accounting standard 17, a company secretary and CFO, in my opinion, and I'm sure it is agreed by a lot of people, that company secretary and CFO are not KMPs for the purpose of reporting AS 18, but for the purpose of reporting under Companies Act, it is required. So that's a very, you will have a different type of reporting for Companies Act and for AS 18. So CEO, whole-time director, in fact, point number 5, such other officer not more than one level below the director who is in the whole-time employment designated as KMP by the board is also covered under a Companies Act, but not told in accounting standards. Such other officers as may be prescribed. So what are the points to be noted here? There could be difference between the definition of KMP under AS 18 and under Companies Act. Under accounting standard 18, non-executive director is not a KMP unless he has the authority for planning, directing, and controlling the activity. The transactions between the company and the independent director need not be reported under related party transactions. So that's a point to be noted. Next point to be noted is what is the definition of a relative, because relative is very important in all these contexts. What is the definition of relative? So we have seen relative for income tax is different. Relatives for accounting standard is different. Relative for Companies Act is different. You will be shocked. Let's talk about relatives for all of us are very familiar with the definition of relative under income tax. When I always put it like this, Aju Baju, Aage Piche, Upar Niche. That means Aju Baju means husband and wife. Aage Piche means brother and sister. Brother and sister. Upar Niche means lineally ascendant and lineally descendant. So this is the definition of relative from the point of income tax, especially when we are talking about things like 40A, 2B, etc. There is another definition of relative when it comes to 56.210, another definition of relative when it comes to section 13, etc., which I am not going to talk about today. But that is a definition. Now, how is it different from accounting standard 18 definition of relative? It is very similar. Aju Baju, husband and wife. Aage Piche, brother and sister. Just to per just niche. That means for accounting standard, father, mother, son and daughter, they are considered as relatives for the purpose of accounting standard 18. So if there is a KMP and their relative, who is their relative means, if let us say managing director's wife is a relative, managing director's brother is a relative, managing director's father, mother, son and daughter, managing director's father-in-law, managing director's grandfather, managing director's grandson is not a relative for the purpose of reporting under AS 18. For Companies Act, we have borrowed the same definition of accounting standard, Aju Baju, Aage Piche, just to per just niche, but we have added one more level called son's wife and daughter's husband. And I wish somebody were there on the screen, I could have discussed with them. When son's wife, Prashant, Praveen, or Ramesh, I don't see you on the screen. Okay, Ramesh, I think we discussed this particular point. Who is a son's wife, sir?
Son's wife.
Son's wife. Who is a son's wife? What is it called in? Right?
Son's wife is daughter-in-law, right?
Daughter-in-law. Daughter-in-law means, you must understand, daughter in which law? Daughter in which law? I always keep telling daughter as per company law. Similarly, husband, the daughter's husband is a son-in-law. Son means son as per company law. So the definition of relative in Companies Act, section 2, subsection 77 of the Companies Act says Aju Baju, husband and wife, Aage Piche, brother and sister, just to per just niche, mother and father, son and daughter, and they have introduced son's wife, daughter's husband. The point to be noted is son-in-law and daughter-in-law are relative as far as Companies Act is concerned, but when it comes to accounting standard, son-in-law and daughter-in-law are not related parties. When it comes to income tax also, son-in-law and daughter-in-law are not related parties. So that is how we have to look into the definition of relatives. So holding company, subsidiary, fellow subsidiary, we know. State controlled enterprise, we know what it is. That means a public sector enterprise. Be it state public sector or central public sector enterprises. Who are all not related parties? Now, if I were to be a director in company A and I were to be a director in company B, company A and B will not be treated as related parties unless I am able to exercise a significant influence in both the companies. Very important point to be noted. If I am not able to exercise a significant influence in these two companies, just because I am a director in both the companies, these two companies will not become related parties. Point number 2, economic dependencies like single customer or single supplier will not make them related parties. Unlike section 92, when for the purpose of transfer pricing, we say when there are substantial transactions between two entities, they are said to be related parties. In accounting standard, just because I am the only supplier or he is the only customer, he does not get related to me. Parties who may participate in making decision making like banks, trade unions, government departments, although they may exert significant influence on me. If the bank is giving me loan, it may say it may tell me a lot of do's and don'ts. It may be able to control me, but in spite of that, they are not considered to be related parties for the purpose of accounting standard 18. Not applicable cases. Not applicable cases means you don't have to disclose related party disclosures in the following cases. When there is a confidentiality, let us say, I was a director in State Bank of Mysore, which is a subsidiary of State Bank of India. The transactions between State Bank of India and State Bank of Mysore, I mean, there could be a lot of running accounts and things like that. Because it is a bank and we are also a customer to the State Bank of India, we would have an account. I don't have to bring out all those transactions by virtue of confidentiality, which is through a statute, regulator, authority, etc. Intra-group in CFS. Look at this. If company A and company B are subsidiaries of company H, okay? So H will show the transaction between H and S1, H and S2 in its individual balance sheet. S1 will show transactions between S1 and H and S1 and S2. Similarly with S2. But when you prepare a consolidated financial statement of H, S1 and S2, in the consolidated financial statements, you don't bring out any related party disclosures for the simple reason that all of them are now bunched into one financial statement. It becomes an intra within the group and within the company itself. Just like for the purpose of CFS, companies become a division. So you don't show related party transactions in the CFS. State control enterprises. Well, let us say there is a Kerala State Tourism Corporation and a Kerala Beverages Corporation, something like that. There are certain transactions. You don't say that they are all the fellow subsidiaries of the Kerala state government and show all the transactions. So they have been exempt from related party disclosures. What is to be disclosed, we have already seen. Even when there is no transaction, where control exists, even when there is no holding and subsidiary, I'll have to say this is my subsidiary, this is my holding company, is what has to be disclosed, even if there are no transactions. Even when there is no transaction, where control exists, name of the related party, nature of the related party relationship has to be shown. When there are transactions, there are various disclosures that need to be done. So please, before I get into what the disclosures are, let me complete this slide. No ICDS equivalent. When related party disclosures are not there in income tax computation and disclosure standards. However, 40A2B wants the auditors to disclose what are all the payments made in excess. And that's a very interesting thing. What are the payments? In fact, under tax audit report, what is asked is what are all the payments done to parties told under 40A2B. So whether or not it is excessive, we have to report there. Okay, but what has to be reported under the income tax return is what are the disallowances to payments made to 40A2B parties which are excessive. So what gets into income tax return and what gets into tax audit reports are two different things. In my tax audit report, all disclosures, if I made a 42 lakhs director's remuneration, I will show 42 lakhs to directors. If I paid to the wife of the managing director 12 lakhs, I will show 12 lakhs. But in the income tax return, if I feel that out of 12 lakhs, 10 lakhs is the reasonable cost, only 2 lakhs is excessive, that excessive should have been shown in the disallowance column under the income tax return. And sometimes we get very funny, what should I say, the notices from the income tax department saying that the disclosures made in for 40A2B under the income tax return is not matching with that made in the tax audit report. Reconcilable. I mean, that is because the questions itself are different. So naturally the answers will be different. So that's a point to be noted. But the point to be noted is no ICDS equivalent, but beware of section 40A2B, section 222E. When you are disclosing this, when you are disclosing a related party transaction, a loans given to a shareholder, if you are showing it under accounting standard 18, and if that shareholder happens to be holding more than 10% shares, and the company is a closely held company, and to that extent you have accumulated profit, then it could become a deemed dividend under section 222E. And this information would also be useful for transfer pricing study. Also ensure compliance with section 188 of the Companies Act. So this is related party. We have seen who is a KMP related party. So if there are no disclosures, I told you, if the relationship is due to control, name of the related party and nature of related party relationship. If the relationship is due to significant influence, no disclosure is required if there are no transactions. But if there are transactions, please understand, if there are related party transactions, both in the case of control or significant influence, the following 7 disclosures have to be made. Which is the name of the related party? Description of the related party, whether it is holding, subsidiary, significant influence, control, fellow subsidiary, associate, joint venture. Description of the nature of transaction, sales, purchases, etc. Volume of transaction. Volume of transaction, it could be amount wise or as appropriate proportion. Any other element of related party transaction necessary for understanding the financial statement. Outstanding items of provisions for doubtful debts. amounts written off or written back in respect of debts, because it may not be there. You would have written off some debts which are given to related party. That also has to be specifically told. The above must be disclosed even if it is done on an arm's length basis. In fact, additionally, we need to know that this is a format which is given in the accounting standard 18, which needs to be complied with. They have given an illustrative format. What they say is illustration, purchase of goods, holding company, subsidiary, fellow subsidiary, associates, KMP, relatives of KMP, total. Let us say I have 2 subsidiaries and I have purchased from 2 subsidiaries 1 crore and 3 crores. So I will say purchase of goods from subsidiaries 4 crores. 1 crore and 3 crore, I will bundle it up and say purchase of goods from subsidiaries 4 crores. But there is another thing. If you look into this, items of similar nature may be aggregated by type of the related party, except when separate disclosure is necessary for an understanding of the effects of related party transaction on the financial statement. So should I give a breakup by the company to S1 how much I have purchased, from S2 how much I have purchased? The answer is given in point number 2 with individual party names if the transactions are more than 10% of the total related party transactions of the same type. Let us say there are 50 company like Tata's or Reliance or our own companies. If we are having got 4 subsidiaries, in one subsidiary we have done very less transaction, but with one we have done more than 10%, or wherever we have done more than 10% transaction, then we'll have to disclose that by names also. So that's a point to be noted. So name of related parties and description. This is how you will. So who are all your holding company, subsidiary company, fellow subsidiaries, associates, KMPs, relatives of KMPs. So let's now get into what are all the substandards. What are all the mistakes that can happen when you are disclosing related party transactions. Related party transaction disclosed, but full disclosures as required not given. You have told, but as required, I told you the 7 points have to be given. All those 7 points are missing. Description of relationship between parties not disclosed or not properly disclosed. Affiliates, common directors, common control. I mean, just in fact, just like I think what Prashant mentioned, they just said common control. Common control cannot be a relationship. We'll have to say whether it is a subsidiary or a fellow subsidiary. So to that extent, we'll have to be specific. Transactions with key managerial personnel are not disclosed under related party transactions. There were payments made to managing directors as salary, but it was not being disclosed under AS 18. Several related party transactions seen in various parts of annual reports not disclosed. I mean, it would be there in director's report or somewhere else, but not in the financial statement itself. Corporate guarantees given for credit facilities extended to subsidiaries or joint ventures, and personal guarantees given by the directors, bar key managerial personnel for loans taken by the company not disclosed. This is a common mistake. I mean, the banks would have given loans to the company, and the directors would have given, the managing directors would have given the personal guarantee, which will not be probably disclosed. Point number 2, names of related parties with whom material transactions have taken place and volume of each such material transaction not separately disclosed. I told you any material transaction of more than 10% of the total. Let us say I have sold 100 crores, out of which the sales to all my related parties is 10 crores. I will have to see how much of this 10 crores ka 10% have I sold to some of the subsidiaries or some of my associates or joint ventures. If within the 10 crores, I will not look into the 10% of my total sales. 10% of the sales done to my related party transactions, that is the breakup I will have to give, which is not given is the allegation that is told. So disclosing transactions with controlling companies and fellow bar subsidiaries together under one single column. So that's what, everything under one single column is disclosed. That is wrong. It has to be properly bifurcated. Breakups have to be given. Related party disclosure, very important. You cannot say related party disclosures as certified by the management. It's very difficult for the auditor to find out who are all the related parties. Of course, I take the management representation before I do my audit, but I should carry out my audit independently and verify it, maybe keep that as part of my audit documentation, but I cannot say related party disclosure is as certified by the management. I have not verified that. That's what is the meaning that comes out by giving such a statement. I will have to verify every statement in the financial statement. If I don't do that, I have to give a disclaimer in my audit report rather than give such a statement in the financial statement. Name of the related party and nature of related party relationship where control exists. should be disclosed whether or not there have been transaction between related parties. There have been controlling parties or controlled parties, but the disclosures have not generally been made is the allegation that is told. Today, because of paucity of time, I may not get into 188 versus Accounting Standard 18. Some other time we could have gone through. Accounting Standard 18 is altogether a different, what should I say? The Companies Act Section 188 dealing with related party transaction is an altogether different thing. So here, company entered into contract or arrangement with related parties. There are 9 types of related parties which they are told. Is it in the ordinary course of business and at arm's length? Then there is no action required. If it is not at ordinary course of business or is not at arm's length, any one of them breaching, then I will have to go and see whether it is a related party transaction as stipulated. They have stipulated 7 types of related party. If the answer is no, the related party transaction as stipulated, they have stipulated 7 types of transaction. If it is not the type of transaction stipulated, then there is no action required. If it is a type of a related party transaction stipulated, then we'll have to see whether the limits have got breached. If the limits have got not breached, then a board resolution is required and a disclosure in the financial statement is also required. But if the limits have also got breached, then there should be a prior ordinary resolution under section 188. So that is a requirement and a distinction between 188 and Accounting Standard 18. I will not get into the details now. Accounting Standard 18 and the relationship with CARO, related party transactions, a transfer of resource or obligation between related parties, regardless of whether or not a price is charged. In CARO, whether all transactions with related parties are in compliance with section 177 and 188 of the Companies Act, whether the details of the transactions have been disclosed in the financial statement, etc., as required by the applicable accounting standards. So in CARO, I will have to talk about whether the applicable accounting standard, this Accounting Standard 18, has actually been disclosed. Yeah, that gets us to the end of Accounting Standard 18. Before I move to the other 2 standards, which I will take it up, any questions, please? Prashant, any questions, please?
Sir, interest is charged.
Yeah.
Interest is charged to P&L account, assuming time required is less than 12 months. And what if the time taken is more than 12 months?
I think we already answered that question.
Sir, is it enough that we have done the related party register maintained by the company and do the audit accordingly?
Yeah, I think if it is a company, they have to give in the first board meeting in MBP1 who are all the related parties. So once they give a declaration, I think we don't have to go beyond unless the auditor has a doubt. He can go by that particular declarations. Because these are very interesting. How will the auditor know who are all the brothers of the director, which are all the companies where his relative is a related party and things like that? It becomes very difficult. So we have to go by their declaration. If based on their wrong declaration, the disclosure in the financial statement is wrong, they have to catch them and not me as an auditor.
Are fellow subsidiary details to be disclosed even if there is no transaction?
Not required, sir, because fellow subsidiaries are not controlling each other. That which is directly controlling me or I am controlling is to be reported. Fellow subsidiaries need not be told if they are not required, if they are not there.
That's all, sir. That's all.
Yeah, let's move to the next point, that is accounting for taxes on income, the most popular standard. Very interestingly, this is a standard on income tax, but nothing to do with income tax. The income tax is least bothered about this particular standard because they don't go to get anything from this particular standard. I may always tell the income tax department, they say, what is this deferred tax that you are showing in the balance sheet? Then I will say that this is a deferred tax liability which I have to pay to you in future. Then sometimes I feel that if the finance minister of the country looks into this, she may say, the country is going through a tough time. Why don't you discount it and give it to me now itself? That's a thing on the lighter side of things. But having said that, deferred tax has got nothing to do with income tax. It is purely arising on account of, what should I say, matching principles, the matching principles. Accounting income and taxable income, all of us are aware. There is a lot of difference between accounting income and taxable income. Accounting income means profit before tax. Taxable income means total income. From the profit before tax, we add certain things, we deduct certain things, and we arrive at the total income. We make a addition and deductions. We make certain additions and deductions. Certain additions and deductions are permanent. It will not go to change in future. But certain additions and deductions, what you added today will get deducted subsequently, or what you deducted this year will get added subsequently to the accounting income, and accordingly the taxable income or the total income will change. Now the point I'm saying is, if the additions and deductions are permanent, those differences between the accounting income and the taxable income are called permanent differences. But if you are adding it now to the accounting income and making the total income higher, like say for example 43B or 40A IA, which subsequently when you make the payment in the next year, it is allowed to be deducted. It is allowed to be deducted. That addition or deduction, that what you add now is going to be claimed in future as a deduction, is only a timing difference. So to the extent of timing difference, you are only deferring the tax payments or taking an advantage of it now. When you can take the advantage of the timing difference, or you suffer on account of the timing difference today. If you suffer today, look at very simple in English, I want to say, and then come to the standard. If you suffer today on account of the timing difference by virtue of 43B additions now or 40A disallowances now, and you are going to get back the benefit in the subsequent year, for the suffering that you had today, you will create an asset for the future. That is called a deferred tax asset. If you have enjoyed some benefit now, you claimed it as a deduction from the accounting income today, but you are going to suffer in future. So you are going to get a benefit today, which is temporary, which is only timing, but you are going to pay for it in future. Then to that extent, it is a deferred tax liability. That in simple words is the definition of deferred tax assets and deferred tax liability. We understand the concept of PBT and total income, additions, deductions, and within additions, there are certain permanent additions and deductions, and within additions and deductions, there are certain timing differences. So let's now formally see what this means. Accounting income in simple terms, we need to understand the definition. Accounting income means profit before tax. Taxable income means total income. So total income means, I said, total income under section 2 subsection 45 of the Income Tax Act. Although this is not told in the standard, this is how we have to understand, plus any foreign income taxes that you have to pay. Not only the income taxes paid domestically, but also the foreign income tax. Tax expense. What is tax expense? The sum total of deferred taxes and current taxes is called tax expense. Current tax means we know very clearly. Provision for tax. The income tax for the year, for the year what you are actually going to pay by virtue of advance tax, TDS, and by regular taxes is called current taxes. Deferred taxes. Deferred taxes is what I just now told. The taxes which you are going to pay, or which you are going to get back, on account of taking an advantage now, or on account of suffering now. So that is called deferred tax. Although formally the definition of deferred tax means deferred taxes are income tax which arise in one period, in year one, but because of timing difference will have to be actually paid in the later years. Or which arise in the one period for which will have to actually be received in the next subsequent years. So now you can take the otherwise also. Here paid means minus thing also is considered as paid. So deferred taxes. Permanent difference and timing difference. Look at this. Ramesh ji, what is the opposite of permanent? Normally permanent, the opposite of permanent is temporary, isn't it? You are muted, sir.
Temporary, sir.
Yeah, but then if you see, very interestingly, in Accounting Standard 22, they have not used the concept of temporary. They have used the word timing difference. The opposite of permanent is temporary, but they have not used temporary. If you go to Ind AS, those of you who are doing Ind AS, the word that is used in Ind AS is temporary differences. So what is the difference between timing difference and temporary difference? Well, if you are dealing only with accounting standards, no problem. You don't have to worry about that. For you, both mean the same. But if you are dealing with Ind AS and international financial reporting standards deal with temporary differences, whereas accounting standard deal with timing difference. The reason that is accounting standard 22 is going by income statement, whereas international accounting standards and Ind AS goes by the tax base of assets and liabilities. It is a balance sheet approach which is followed in Ind AS and the IFRS, whereas in the accounting standard 22, it is the profit and loss account approach, the income statement approach. When why the difference, I would not like to talk about that now. Some other forum I would like to talk about it. So the opposite of permanent is timing, not temporary, for accounting standard 22. But for Ind AS, Ind AS 12, which deals with the deferred taxes, the opposite of permanent is temporary. Rameshji, again I will extend this. What is the opposite of temporary?
Permanent.
It may look very, very silly. The opposite of temporary is other than temporary. You know, in accounting standard 13, I see Praveen there. Praveen, very interestingly, in accounting standard 13, they use the word, and accounting standard 13 deals with the investments. Investments can be of three types: current investments, long-term investments, investment properties. Current investments have to be measured at cost or fair value, whichever is lower. Contrast this with accounting standard 2. Accounting standard 2, inventories have to be valued at cost or net realizable value, whichever is lower. In accounting standard 13, it is cost or fair value, whichever is lower. So what is the difference between net realizable value and fair value? Some other time, I will not talk about now. Now, next point is investment properties can be of short-term current investment, long-term investments. Long-term investments are valued at cost unless there is a decline in the value for reasons other than temporary. Investment properties has to be valued using the cost model as told in property, plant and equipment, accounting standard 10. Now, why I am telling all these terminologies? Timing difference, Ind AS temporary difference, accounting standard 2 net realizable value, accounting standard 13 for current investments, it is fair value. And for accounting standard long-term investments, it is for reasons other than temporary. All these terminologies have to be used in the financial statements as told in those particular standards. If you interchange these terminologies, it will give rise to a different meaning. So don't use, that's what I say. The terminologies of the standard are very sacrosanct. They are not interchangeable. I cannot use my own thing and say permanent and temporary difference here. It has to be permanent and timing. There it has to be other than temporary. In accounting standard 2, it has to be net realizable value. In accounting standard 13 for current investment, it has to be fair value. If I misplace, although this in fact, there are a lot of differences between these. That is what I'm coming to. It is not just terminologies. There are a lot of differences between the names and why it is called like that. I know 3 hours is a long time, but it is a very short time for me to explain all this. But some other time I would love to talk. For that. I would like to come to Kerala and do that, not sitting out of my cabin. That's the point I'm saying. Okay, timing difference. Recognition. Point number 1, tax expense. You have to recognize the tax expense, which is not only current tax, but also deferred tax. Deferred taxes for all timing difference. You will have to recognize deferred taxes for all timing differences subject to prudence. Now, what is this prudence? We will see a bit later on. You will have to recognize, okay, let me finish off that. Deferred taxes should be recognized for all timing difference subject to consideration of prudence in respect of deferred tax asset as set out below. Now, before I get into this definition, I have to tell you one thing. We did not talk about permanent difference and timing difference in that sense, and let us say the examples and then go to that. Timing difference is equal to difference between total income and accounting income for a period that originate in one period and are capable of reversal in one or more subsequent periods. We don't say that they will definitely reverse. We say that they are capable of reversal. So therefore, that word capable of reversal is important. Permanent differences means permanent differences are the difference between total income and accounting income for a period that originate in one period and do not reverse subsequently. Authoritatively, we'll be able to say that they do not reverse. I mean, I just took up an example to say PBT maybe 100 crores, taxable income, that is the total income is 70 crores, and the difference of 30 crores could be on account of timing difference and permanent difference. So permanent difference means red, I cannot get that back, such as 40A3. Such as 40A3, more than 10,000 rupees I pay, it is a permanent difference. Timing difference could be on account of 40A1A, 40A3, I mean, sorry, 43B, 40A1, 40A1A, things like that, including depreciation. So timing difference could be on account of depreciation. Because I took more depreciation for income tax now, look at this. Normally it happens, 35% is the depreciation on plant and machinery in the first year. But for accounting purpose, I take only 15%. So I took extra 35 minus 15, 20% extra in the income tax. I will have to pay it in future. So to that extent, the benefit which I have taken now, in future I will suffer. So therefore a deferred tax suffering, deferred tax liability has to be created. Reverse of that, suppose accounting, I write off, let us say I purchased a mobile phone and I feel that it is not a material item for accounting purpose and I write it off. 1.5 lakhs I debited to my profit and loss account. But income tax says even if the item is not material, it has to be added to the fixed asset and depreciation has to be claimed. So let us say on this 1.5 lakhs, I claimed 15% depreciation for income tax purpose, but 100% write off in accounting. So my accounting profit is lower. My accounting profit is lower, my tax profit is higher. Okay, but the benefit of this higher tax profit on which account of which I paid higher taxes this year, I will be able to reclaim in the subsequent year. So I will have an advantage in future. So a deferred tax advantage is a deferred tax asset. I mean DTA, I call it as deferred tax advantage. A deferred tax advantage in future is what I have to create now. So that is how the depreciation happens, 43B. So let us see. I mean, I just made a list of what are all the various timing differences that we can have. One of the timing differences is mostly on account of whether we have 40A1A, 43B, etc. Even if I am a highly compliant company, I may have differences on account of fixed assets, depreciation especially. Difference in depreciation between the accounting and the tax on account of different rates, sometimes 100% under 335 AD or 35% under 32(8) class 2 and 15% a normal accounting to Companies Act and whatever. Different methods. I am following straight line method there and WDV method here. Block of assets versus individual assets. So here I have to do individual assets wise in accounting, whereas there it is a block of asset. Difference in composition of the actual cost of assets. Whereas for accounting purpose, all costs have to be considered. Whereas for income tax purpose, if I pay something more for buying a computer or any asset, more than 10,000 rupees per person per day, it cannot enter the cost of asset and therefore depreciation cannot be claimed. So difference in composition of the actual cost of assets, pro rata treatment versus 180 days. Accounting says depreciation has to be calculated pro rata. If I have purchased an asset in January, I can claim the 3 months depreciation. But for income tax purpose, I can claim 50% of the depreciation for assets used for less than, when normally we say Gandhi Jayanti is the cutoff, sir. Please understand, Gandhi Jayanti is the cutoff. Anything bought before October 2nd, you can claim full depreciation. Anything bought after October 2nd, you can claim 50% depreciation. Exchange fluctuation of foreign currency liability incurred for fixed asset purchase. Now that could also be a reason. Write-off in accounts due to amounts not being material. I told the example of mobile phone. Impairment losses as per accounting standard 28 not recognized for income tax purpose. Sale proceeds credited to block of assets as per Income Tax Act versus profit or loss on sale of fixed assets recognized in profit and loss account is also a permanent temporary difference. Please understand this. But I'm not going to explain the logic today. Purchase of scientific, normally I explain logics when I'm dealing only with one standard. Now today I'm dealing with 4 standards, so I'm just pushing it. So purchase, but very important for all of us to know the logic. Then we will understand we'll get a kick out of it. Purchase of scientific research assets. Now there could be other reasons also, like timing differences, expenses debited to profit and loss account on accrual basis. but allowed on actual payment. We talked about 40A1A, 43B, 40A7 gratuity, or provisions made in profit and loss account in anticipation of liabilities allowed only when liability crystallizes according to income tax. There could be other adjustments such as provision for doubtful debts, reducing my accounting income, but for income tax not considered unless it is bad debts are actually written off. Preliminary expenses written off fully when incurred, 35D. Written off in the books, but in income tax I'm allowed 1/5. Expenses amortized in the books of accounts over a period of time, but a shorter, longer period is allowed for tax purposes. Diminution in the value of investments for reasons other than temporary. It is not allowed for income tax purpose, but for accounting, I've already dropped my accounting income, giving me a deferred tax advantage in future. ICDS related adjustments. So these are all the various adjustments. Now, what are the permanent differences? Permanent differences could be amortization of goodwill considered as disallowable expenses, personal expenditure disallowed by tax authorities, penalties not being compensatory in nature, payments disallowed under 40A3, donations disallowed under 80G, remuneration to partners disallowed under 40B5, scientific research expenditures, exemptions under section 10A, 10B, permanent advantages, deduction under section 80IA, 80IB, 80IC, permanent advantages, financial lease depreciation, annual depreciation or additional depreciation or revaluation. So we were coming to this. I said that whenever you are creating a deferred tax asset, so we know when a deferred tax liability is to be created and a deferred tax asset is to be created. I'm not talking about the accounting aspect of it, the numerical value of it. So once we arrive at the deferred tax liability, deferred tax liability has to be accounted because it is a duty. Deferred tax asset, deferred tax advantages, that means the future advantage may or may not happen. So therefore, for every deferred tax asset, I cannot create a asset. For every possibility of an advantage that I have, I cannot create an asset. Please understand, a huge depreciation loss, unabsorbed depreciation loss, unabsorbed business loss can also be will also be allowed to you in future. That is also a deferred tax asset to you. That is also a deferred tax asset. But should I recognize that or not? That is the prudence that we are talking about. Deferred taxes should be recognized for all timing differences, subject to consideration of prudence in respect of deferred tax asset as set out below. Consideration of prudence is a must while recognizing deferred tax asset. If the deferred tax asset is arising due to unabsorbed business or unabsorbed depreciation loss, you can recognize it only if you are virtually certain and you have a convincing evidence. Of what? Of you having a sufficient future taxable income to set off such deferred tax asset. Now, please understand, this convincing evidence is not based on just forecasts, perception, projections given to external agency. It is not based out of project reports. It is an evidence which must be shown, which should be evidence must and should be available at the reporting date in a concrete form. In a concrete form, I have given that a profitable binding export order, cancellation of which will result in a payment of heavy damages by the defaulting party. Only if I have so much of confidence in the balance sheet date, then I will recognize this. Otherwise, I will not recognize the net deferred tax asset arising on account of unabsorbed business or unabsorbed depreciation loss. If it were to be any other than above, if it is 40A1A, 43, 40A7, 43B, such things, reasonable certainty of what? Of sufficient future taxable income to set off that such deferred tax asset. So how do I as an auditor have a reasonable cause? Means examine the past records and make realistic estimates of future profits. So if that is there, then I can take cognizance of the deferred tax asset arising on account of other than unabsorbed business and unabsorbed depreciation loss. A very important point to be noted. Suppose I have a capital loss. Now all of us know that loss on account of capital gains in future can be adjusted only against loss on account of capital gains. When I have a capital gains in future. And that too, long-term can be only against long-term. So that is also told very clearly. Long-term losses can be claimed only against long-term gains. Now, if I have a long-term capital loss, can I create a deferred tax asset? The answer that is told is unless you have a convincing evidence on the balance sheet date, or at least until the date you signed the balance sheet. That is, events occurring after the balance sheet date can be considered. Until that date, if you have a capital gain arising in subsequent period, that to an account of long term, then you can recognize long-term capital loss deferred tax asset on the balance sheet date. So you'll have to do so much of calculation. So this is about prudence. That's what we were going back to this. So deferred tax for all timing differences subject to prudence. So we have seen what prudence is. Reasonable certainty rule we have seen. Virtual certainty rule and meaning thereof. Virtually certain means you should be having certainty through some orders, etc., backed by convincing evidence. And once you create a deferred tax asset, you will have to review it every year for any ups and downs. So how do you measure and disclose the deferred taxes? Tax rate for current taxes, we know how it is to be calculated. For deferred taxes, but let us say everything last year in 1920, the tax rate was 25% or 30%. But they said if you are coming under 115 BAA, it may be slashed down to 22%, and if you are coming under 115 BAB, it may be slashed to 15%. Anyway, BAB was for new companies. So for existing companies, it could have gone down from 25 or 30 to 22%. Now, should I create my deferred taxes? At what rate should I use to calculate my deferred taxes? The answer is very simple. The tax rate which you will use for in future to unwind that is the rate you will have to use. So for in that year, in 1920, I think in 1819 when it was there, what we did was, for the current taxes we calculated 25%, but for deferred taxes we used 22% rate. So because the future rate is what has to be adopted. How do you know the future rate? Because on 31st of March, you know that the budget has already come on 1st of February. It would have more or less got synchronized. Even if the president has not given his accent, probably if it has passed through the Rajya Sabha, Lok Sabha, then Rajya Sabha and president is only a process. So if it has substantively got enacted, that is the word they use, substantively enacted laws and rates by the balance sheet date has to be considered for deferred taxes. And in case for in fact, is it applicable for non-corporate entities? Is accounting standard 2 applicable for non-corporate entities? The answer is given below. Applicable to all companies. Like AS 18, it is also applicable to all companies. And all levels, it is applicable to level 1, level 2, level 3, level 4. But the only exception is for level 4. For level 4 entities, current tax provisions only have to be considered. Deferred taxes need not be considered. So that's the best part. For level 4, you don't have to make a provision for most of your balance sheet and my balance sheets. We don't have to provide for deferred tax liabilities because our turnovers are less than 10 crores. If it all turnover is cut off is 10 crores there, and borrowings is less than 2 crores. Then we come under level 4. So in that context, deferred tax asset or liability need not be recognized for level 4 entities. So now we are talking about if in the case of level 2, level 3, level 1 individual, you have to calculate the deferred taxes, and you know his taxes will be up to 5 lakhs, then up to 2.5 lakhs, then 2.5 lakhs to 5 lakhs, 5%, 5 to 10, 20%, more than 10, it is 30%. So what rate should I adopt? What rate should I adopt means he says average rate in case of slab rates. Now we don't know what is average rate. How to calculate the average rate may be a very difficult thing. It is not simple average. It should be weighted average, and therefore depending on the type of entity it is, we'll have to work out accordingly. MAT rate not to be used. DTA, DTL not to be discounted. Although you're going to pay it in future, you don't discount it now. But for Ind AS purpose, we have to discount it. Set off. This is a very important thing, and mostly people commit a mistake here. I have seen. Set off. Current tax assets and current tax liability. Please don't have provision for taxes in your liability and advance taxes and TDS as an asset. It has to be offset, and the net only has to be shown. Either it should be refunded due in the asset, or provision for tax net payable as a liability. It cannot be two different things separately. Similarly, deferred tax assets and deferred tax liability has to be offset. Unless deferred tax asset is in America and deferred tax liability is in India. That means if it is in 2 different jurisdictions, then you cannot offset it. Similarly for current taxes and current liability. If it is pertaining to different jurisdiction, of course, you cannot offset it. Point number 5, disclosure of DTA, DTL, breakup of DTA and DTL into major classes, nature of evidence supporting recognition in case of, very important, we have to give the major breakup of DTA and DTL into major classes. Is it on account of depreciation? Is it on account of 40A1A? Is it on account of 43B? I will have to give the components of deferred tax assets and deferred tax liability. And if I have recognized a deferred tax asset, even when I am having a unabsorbed depreciation loss or unabsorbed losses, then I will have to also disclose the nature of evidence supporting the recognition in case of DTA arising out of unabsorbed depreciation or carried forward of losses. Here, let me tell you one thing very importantly. If I have a loss, if I have an unabsorbed loss of 10 crores, okay, I have an unabsorbed loss of 10 crores. That means in a company, I can, let us say I'm a 30%, I'm in the 30% bracket for whatever it is. So up to 3 crores, I can recognize a deferred tax asset. But I will say, no, I have no convincing evidence. So 3 crores, I will deferred tax asset I could have created, but I'm not creating. But in the same context, I have a deferred tax liability in the same company. I have a deferred tax liability because of some depreciation or some 35AD advantage that I have taken. I have depreciation liability, deferred tax liability of, let us say, 1 crore, tax liability of 1 crore. Please understand, I cannot say I will show deferred tax liability of 1 crore and not recognize 3 crores deferred tax asset. It is not like that. The net deferred tax asset is 3 crores. Deferred tax liability is 1 crore. The net deferred tax asset is 2 crores. The net deferred tax asset is what I am not going to recognize. It is not that I recognize deferred tax liability of 1 crore and ignore entire 3 crores. That will also be wrong. So point to be noted. Miscellaneous treatment in case of ATIA, ITIB, tax holiday, 10A, 10B exemptions. The standard gives illustrations as to how you have to do. I'm not going to talk about that. Capital gains we have discussed, MAT we have discussed, amalgamation we don't have to discuss because it is everything in the standard we don't have to discuss because it may not be applicable to most of us. So that's about deferred taxes. Yeah, I think what are the issues that come out? What are the issues? Accounting for taxes on income in the context of 115 JB we have already seen. Accounting for taxes on income in consolidated financial statement. In consolidated financial statement, please understand, deferred tax liability of subsidiary and deferred tax asset of a holding company cannot be offset. It has to be kept separately. It has to be kept separately because it is falling under 2 different jurisdictions. Okay, then accounting for taxes on income in interim financial report, follow accounting standard 25. Is it okay not to recognize DTL on the ground that the enterprise intends to carry out a major capital expenditure program in the near future? The answer is you have to see it on the balance sheet date and not subsequent events cannot dictate what has to happen on the balance sheet date. Is it okay not to recognize deferred tax liability on the ground that the company expects that there will be a loss both for accounting and tax purposes in the near future? The answer is no. Now, what are the substandards? What are the substandards? Disclosure of major what are the mistakes pointed out by FRRB? Saying on account of AS22, disclosure of major components of deferred tax asset and deferred tax liability not given in the notes to accounts. When I told you on account of depreciation, on account of 40A1A, on account of 40A7, you will have to say that that has not been, major components have not been given. Not offsetting advance tax and provision for tax within the same jurisdiction. We already discussed this. So not offsetting, if you leave it like that, asset and liability, then it is considered as an offense. Setting off deferred tax asset and deferred tax liability of 2 entities in the consolidated financial statement is also an offense. What has to be set off has to be set off. What cannot be set off should not be set off. I think that's the answer. Huge losses, but still DTA created. Reasonable certainty versus virtual certainty backed by convincing evidence requires disclosure. So they have not disclosed, but they have recognized deferred tax liability asset, although there is huge losses in the balance sheet. Recognizing DTL fully without considering DTA arising out of unabsorbed depreciation and carry forward losses. I told the example of 3 crores deferred tax asset and 1 crore deferred tax liability. He has recognized only 1 crore liability without recognizing 3 crores deferred tax asset. No doubt you don't have to recognize net. That's the point, is 3 crore DTA minus DTL 1 crore, 2 crores. So you don't have to recognize the net DTA of 2 crores, but that does not mean that you will not recognize that 1 crore. You will recognize only that 1 crore liability. So FRRB says DTA, at least to the extent of DTL, should have been recognized even if there is no virtual certainty and convincing evidence. Point number 6, classify. This is a very interesting thing, Ramesh ji. You will understand. Interest paid to income tax department under 234A, B, C is not income tax. Therefore, it should not enter tax expense. It should be classified under finance cost as per guidance note on Schedule 3 and not under tax expense. Although it is paid to the tax department, the point is you would have otherwise paid it to the bank if you had paid it on time. They could have loaned and paid it to the bank. So therefore, it is a finance cost and not a tax expense. Deferred tax asset and deferred tax liability has been provided in the books of accounts as per, saying that like this, as per AS 22 of ICAI using prudence. That's it. That's the disclosure which has been given, which is wrong. Explicit reproduction of the entire policy is required to help readers of the understanding the financial statement. So what is the explicit? In our office, we give this particular disclosure. Income tax, accounting policy and income tax, we have to give. Tax on income for current period is determined based on the taxable income, and tax credits are computed in accordance with the provisions of Income Tax Act 1961 based on the expected outcome of assessments or appeals. Minimum alternative tax paid in accordance with the tax laws, which gives future economic benefits in the form of adjustments to future income tax liability, is considered as an asset. If there is a convincing evidence that the company will pay normal income tax, accordingly, MAT is recognized as an asset in the balance sheet when it is probable that future economic benefit associated with it will flow to the company. Please understand, if you have opted for 115 BAA or BAB, this concept of MAT will not be there. Deferred tax is recognized on timing difference between the income accounted in financial statements and the taxable income for the year, and quantified using the tax rates and tax laws enacted or substantively enacted as on the balance sheet date. Deferred tax assets relating to unabsorbed depreciation by business losses under the head capital gains are recognized and carried forward to the extent there is virtual certainty supported by convincing evidence that sufficient future taxable income will be available against which such deferred tax assets can be realized. Other deferred tax assets are recognized and carried forward to the extent there is a reasonable certainty that sufficient future taxable income will be available against which such deferred tax assets can be realized. Better to follow this accounting policy. If you change any one word of this and try to bring in your words, it could lead to terminology issues and therefore attract the eyes of FRRB. Any questions, sir? So what I will do is now, since I have got only 23 minutes, I'll quickly finish off provisions and then take the questions in totality. I think that would be better. So I will just not get into the details of provisions because, of course, this is a very important standard. Ramesh ji, can you tell examples of provisions? Maybe Praveen also can join. Examples of provisions under accounting standard 29. Popular provisions. Praveen, I think you can also give a try.
Provision for deferred tax asset.
Provision for deferred tax liabilities, deferred tax assets are not covered under AS 29 because they are covered under AS 22. Praveen or Prashant, you can also join. I would like to know what are all those provisions which are covered under AS 29. Give me examples which you have in here. There are a lot of provisions, right? Provisions for what?
The doubtful debts.
Yeah, provision for doubtful debts is not covered under accounting standard 29. It is covered under accounting standard 4. Contingencies, initially contingencies and events occurring after the balance sheet date. Provision for bad and doubtful debts is covered there and not under. Please understand, an asset having a provision, could be like provision for doubtful debts. It could be provision for depreciation, provision for impairment. Okay, all these are not covered under accounting standard 29 because they are asset-based provisions and not a liability-based provision. What is covered under AS 29 is a liability-based provisions. What else could get covered?
The expense
Liquidated
table.
damages.
Provision for
Liquidated damages.
Provision for liquidated damages. Yes, I could take that, but still. What is a liquidated damages? Let us understand what is a liquidated damages. Liquidated damages means what I have to pay to the customs or to any other authority in submission of any goods. Okay? So provision for liquidated damages. I'll park it aside. What are provision for audit fees? Does it get covered under AS 29? Provision for audit fees.
It should.
Provisions for expenses. I mean, provision for I have received some what should I say services, and I have to pay. Let us say employee's salary which is not paid on 31st of March. I made provision for
Salary payable.
Provision for salaries. Is that the provision that we are talking about in Accounting Standard 29? The answer is no. Please understand. Accounting Standard 29 provisions is different from accruals. In anything that I have to pay for goods and services received, can be a trade payable, can be an accrued expenses, or in the worst case, a provision for expense. All accrued expenses, we loosely call it as provision for expenses, but all accrued expenses are not provision for expenses in that sense. I mean, it's not a provision to be dealt with under Accounting Standard 29. Let me tell you once more. See, accrual, for accrual, I don't need Accounting Standard 29. Accounting Standard 1 itself takes care of accrual. There are three important fundamental accounting assumptions: going concern, accrual, and consistency. I mean, GAC, what we say, going concern, accrual, and consistency. So accrual is dealt with in Accounting Standard 1. I don't have to come to Accounting Standard 29 to create a provision for audit fees, a provision for liquidated damages, a provision for salaries. So I don't have to really come to Accounting Standard 29 for that. Then you may say, what is this provision then? And how is it different from that accrual? Trade payable, I get a bill. In accrual and in this provision, I don't get a bill. I don't get an invoice. Okay. But in the case of accrual, let us say provision for rent of March, provision for month of March, rent payable for the month of March, I made a provision. I made a provision for whatever services received and for which I have to make the payment. Please understand, there I know what is the amount to be paid. That is what is coming under accrual. A provision which comes under AS 29 is that provision which requires a substantial degree of estimation. Substantial degree of estimation. That is the provision that we are talking about. So what could such type of provisions be? Provisions for, let us say, income tax disputes. It is not a accrual concept. It is some tax disputes which I have. I mean, I think that I don't have to pay, but I make a provision. Or if they have made a claim against me and I feel that I don't have to pay it, then it becomes a contingent liability for disclosure. So in short, a liability for which I receive an invoice becomes a trade payable. For which I don't receive an invoice can become accrual and provision. In the case of accrual, I don't have to make too much of estimation. I know how much it is, how much has to be paid. It is negotiated or contracted. But in the case of the provisions where substantial degree of estimation is involved, that is the provision that we are talking about. That could be provision for income tax, provision for GST, where I don't know how much I have to pay. There could be a higher claim or whatever. Or it could be on account of some trade or litigation. I mean, some claim has been made by a third party. I don't know how much I have to give through the court may come and say how much I have to give. That could be a thing. For an account of environmental damages, there is a claim. I have to make that payment. Or it could be a warranty. I have sold something and there could be a warranty or a return for which I have to make a provision. So these are all the provisions that are dealt with here. I will not get today into the details of this. I'm just with one slide. I'll finish off and then close the session taking questions. For definitions, I have to see, well, what is the obligation? Do I have an obligation? Is the obligation a present obligation or a possible obligation? If it is a possible obligation, there is a possibility that I have to pay, means it becomes a contingent liability. If the obligation means liability only in simple terms. If the liability is present on account of which, please understand, a provision is always a liability. A provision is always a liability where a substantial degree of estimation is involved. And what is a liability? A liability is a present obligation arising on account of past events from which future economic benefits are likely to flow out of the organization. So that is a liability. So if that liability involves a substantial degree of estimation, that becomes a provision. So present obligation. Possible obligation means may or may not happen at all. In that context, I will take it as a contingent liability. Liability, I told you what it is. Provision, I told you. Provision involves substantial degree of estimation. Trade payable, accrual, we told what it is. This standard also talks about restructuring. That means if I have decided that I have to restructure, and if I have decided this year that I'm going to restructure my organization, move my organization from here to somewhere else or whatever like that, I will not take cognizance of that unless there is a binding sale agreement. Otherwise, accounting standard 24 discontinuing operation will take over that. So provision definition we have seen. Recognition criteria means there should be a present obligation, probable outflow, reliable estimate. All these three things must be there to make a provision. One of them missing means it will not be a provision. Present obligation, probable outflow, but I'm not able to estimate means it becomes a contingent liability. Onerous contract. I mean, this also talks about onerous contract. If I have entered into a contract with so for somebody to sell, let us say, a computer for 1 lakh, I have said that I still don't have the computer. I said I will sell this computer for you at 1 lakh. But when I went into the market, I realized, I have told that I will sell it to you at 1 lakh and signed the document. But I realized that for me to buy this computer, it will now cost me 1,20,000 rupees. So I have to incur a loss of 20,000 rupees to do this. So this type of contract is called an onerous contract. When we keep telling, the chairman is doing the onerous task of, the onerous task means the benefit that is available to him is less than the cost that is, whatever, the cost he is incurring is more than the benefit that he is getting in return. So that is an onerous contract, has to be recognized. I don't wait. Even if I have to deliver this particular contract next year, I will account for that particular loss this year itself. That is by virtue of prudence, onerous contracts have to be considered. What do I disclose? Disclose for each class of provision amounts which is equal to opening balance plus additions plus minus reversals, which is equal to closing balance, para 66. Para 67, I have to say nature of obligation, timing of the outflow, uncertainties and assumptions, and expected reimbursements. So how do I measure the provision? The best estimate, no discounting, except for, what does a DRL means? Recognized as cost of property, plant and equipment. That is restoration liabilities. Okay, if I have to restore the asset in future, I will, let us say I have an oil field, or why for that matter, I have taken a building on lease for, let us say, 10 years. Then what I do is I will do all the interiors, and the landlord says after 10 years, you have to remove all the interiors and give it back to me as it is. Okay, so that type of, what is it called? DRL, I think. Yeah, I think, I'm not able to get the point is that basically the restoration of the asset, which I have to give it back in the same manner, has whatever I have to do after 10 years. Let us say today I incurred 100 crores. In a lot of MNCs will do that. I have taken a building on lease. I have incurred 10 crores for doing the interiors. But the owner says after 10 years, you have to remove all these and give it to me. So what I will have to do is 10 crores is my asset. For removal, I will incur 1 crore at the end of 10 years. So what I will have to do is that 1 crore also I have to create a liability today. All these days I had to create a liability to the extent of 1 crore, but now from 2016 onwards, I will have to discount that because 1 crore I incur at the end of 10 years. So today's value may be only 30 lakhs. Every year I have to show the borrowing cost, the finance cost, and make it 1 crore at the end of 10 years. So 30 lakhs also I added to the cost of the fixed asset and depreciate it that side. And here I will show this as a liability build up every year. Evidence analysis before taxes, it has to be done before taxes. Consider risks and uncertainties not to be excessive. Be prudent. Future events can be considered. Gains from expected disposal of assets are not considered. Reimbursement. Suppose I have to make a provision and somebody else is also going to give me that reimbursement I can take if I'm virtually certain. So I make an offset, but that offset in the profit and loss account can be done, but in the balance sheet, I have to show the provision and the reimbursement receivable as a asset separately. Review the provision at every balance sheet date. Reversal of provision is possible. And I can adjust the one provision against the same provision. When I cannot, for different heads, I cannot use the provision between the heads. No provision for future operating losses. Restructuring costs also has to be considered if there is a binding sale agreement. What about contingent liabilities and contingent assets? Contingent liability by definition means that where the outflow is possible, the chances of its recurrence is lower. So that becomes a contingent liability. No recognition, review at each balance sheet date, but disclosure of contingent liability is to be done. There are exemptions from disclosures in certain cases. If it is going against you, you have the possibility of not disclosing it, but why you have not disclosed and what you have not disclosed has to be told. Contingent assets, they have told definitions, that the possibility of an asset coming to you. So that is what is told. No recognition, review at each balance sheet date, no disclosure in the financial statement, disclose only in the director's report. So I will not get into the details of this today. Yeah. So I'll just get into what are all the substandards. Auditor commented in CARO on disputed dues and forum before which it is pending, but it is not disclosed as contingent liability. In CARO it is there, but in financial statement it is not there. Disclosure of unpaid expenses under the head provision is wrong, as we discussed. Liabilities will be paid as and when claimed. Indicates that the probability of outflow of resources not provided for. Guarantees given by the banks for performance of the contracts and others shown under contingent liability. This is wrong. I mean, according to the guidance note on Schedule 3, guarantees given against own performance of company do not give rise to any contingent liability, because the company in any case holds an obligation to perform the event against which guarantee is given. So major differences between Accounting Standard 29 and ICDS. Onerous contract, what I told you, 1 lakh if I have contracted to sell, and 1,20,000 is what I have to buy and sell. So 20,000 I account it in year 1. Whereas ICDS says, I will not allow you in year 1. Let the loss actually happen, then I will allow you. In the year in which it is incurred, it will be allowed. For accounting standard purpose, in the year in which you realize, that means you know that you are going to incur, that year itself you have to provide. Provisions, when I don't see it's only an English change there, I don't really am concerned with that. So following disclosures have to be done. This is the disclosure that is required. So this gets me to the end of almost 3 hours, but I can take questions. But please understand, accounting standards retain the help in ensuring that the quality of the financial statements is proper. And I think I go with what the President of India mentioned. White collar crimes don't leave behind a smoking gun. They leave behind broken hearts and a shaken confidence. When imagine some company, some investor has invested by virtue of our audited financial statement, when it could lead to broken hearts and a shaken confidence in the entire system. I think we should not be part of that. When I somehow sometimes feel, why is it that in spite of so many accounting standards, accounting scams happen? The answer for that is, I will not say lie. It does not lie with the accounting standards. I mean, if you have been given a very good car, a German car, it is not the mistake of the car because of which the accident can happen. It is because of the driver, the rash driving of the driver, because of which the accidents will happen. So let's not blame the car. We should blame the driver. So we should not blame the standards. The standards are intact. The persons who have to follow the standards have to be intact. So before I wind up, I will say, apart from the accounting standards, we have to comply with the standards on auditing and the code of ethics. I always keep telling this, Rameshji, I don't know whether I told you that, in Hyderabad, there was a chairman last year was Pankaj Trivedi. I told him, what is Trivedi? Trivedi means one who specializes in 3 Vedas. Samaveda, Atharvaveda, Rig Veda, one Veda is left aside. That is a Chaturveda. If you become a specialist in all the 4 Vedas, you are called Chaturvedis. I think as chartered accountants, we should be at least Trivedis, if not Chaturvedi itself. I mean, Income Tax Act also, if you know, you become a Chaturvedi for income tax purpose. So I have to close here to saying that I am proud to be a chartered accountant. Now let's be a standard accountant also. But then whenever in doubt, I like this particular statement which I read yesterday. I thought I will share it with you. Always listen to your heart. It may be on the left, but it is always right. So with that, I will now take up as many questions as the organizers want. Yes, please. questions on any accounting standard, questions on any income tax matter connected to the accounting standards.
Praveen, can you take up the chat box?
Actually, I was disconnected for a while, so I can see only 3 questions. I'm not sure only 3 are available.
It is how to verify how to verify related parties in the case of government companies where directors may be directors in different companies.
I think, see, the managing director, as I told you, if there are directors in different companies, we don't really have to worry. State government, I mean, the government entities have been given an exemption as far as reporting government entities. Other government entities are not to be disclosed.
In the case of NBFC, whether the provision for substandard assets have to be taken into account for deferred tax?
In the case of
NBFCs.
NBFC, non-banking finance.
Yes, sir. I mean, see, very simple. Is that, I mean, in banks, we have one peculiar situation, unlike in the case of normal business entities, where based on provisions also, income tax benefits are allowed. If the income tax benefits are allowed in the same year based on your provisions, then there is no question of having a deferred benefit in future. However, if that provision in banks also, we know that the provision up to 10% of the advances in the rural areas, etc., there is a ceiling. But if you have done a provision much more than that and up to a ceiling only it is allowed in income tax, in that context, the differential provisions, to that extent, you can claim it as a deferred tax asset in your books.
The next question, the company incurred heavy losses, so it could not create a DTA, whereby its net profit increased for the current year. But there are reasonable circumstances that the company will earn sufficient profit in the future. So is it justifiable to keep the DTA in the balance sheet or write it off?
Sir, I mean, the point is you should not have created a DTA, first of all. I think the test of prudence is at the time of creating DTA. Now that you have already created a DTA, you should have reviewed it at every balance sheet date, and unless that, I mean, let us be very clear, if the DTA is created on account of having unabsorbed depreciation and unabsorbed losses, you should have had a convincing evidence at that stage itself, at the time of creating. Subsequently, I mean, if you wrongly created it and on the balance sheet you still don't have it, I would say you better write it off. You have to write it off. I will tell you a different situation. In the year in which you incurred the loss, you did not create. But subsequently going forward in year 4, year 5, you recognize that there are now very good orders based on which you are able to recognize based on which you will be able to absorb that particular loss. In year 4 or year 5, you can recognize the deferred tax asset.
That's all in the chat box, sir.
Yeah.
Prashant?
Dear members, any more questions you can put in the chat box. If there are no more questions, shall we proceed to the next agenda, sir?
Yeah.
I'm okay, sir. Thank you.
I request the Secretary of the Kottayam branch, CA Prem Sebastian Anthony, to propose the vote of thanks.
Respected CA Rajneesh, our Chairman of ALAPPUZHA branch, CA Praveen Narayan, Chairman of KOLLAM branch, CA Aryan KK, Chairman of THRISSUR branch, CA Ramesh Kumar, Chairman of Thiruvananthapuram branch, my dear CA Prashant Srinivas, Chairman of Kottayam branch, respected faculty of the day, CA Gururaj Acharya sir, Honorable immediate past Chairman of SIRC, CA Jomon sir, respected managing committee members of the 5 branches, respected senior members, and my dear fellow members, a very good evening. Today we are coming to the close of the 3-day virtual seminar on accounting standards organized by ALAPPUZHA, KOLLAM, Kottayam, THRISSUR, and Thiruvananthapuram branches of SIRC ICAI. We got the opportunity to have a comprehensive understanding of the 15 significant standards out of the 29 -2 accounting standards. Before moving on to with the vote of thanks, let me thank God Almighty for letting us to conduct the program without any hurdles. There's a saying, everything is for good. Even now, even when the corona virus forced us to go for virtual sessions, then we got the opportunity to conduct and attend many joint sessions with many eminent faculty without any distance barriers while sitting at the cosines of our own premises. The session of this level would have been a mega program in the physical mode. On the first day of the program, our dear Jomon sir commenced with the introduction and went up to the 9th standard. Yesterday, Chinnasami Ganesan sir, as rightly mentioned by CA Rama Sharma yesterday, the Periyasami of standards have covered accounting standards 10, 11, 15, and 26. Today, we are convinced of what Prashant sir has described about our faculty of the day, CA Gururaj Acharya, as the 3-in-1, Guru, Raja, and Acharya of accounting standards. Thank you, sir, for the in-depth, informative, and incredible session on accounting standards 16, 18, 22, and 29. On behalf of all the 5 branches of SIRC, we genuinely express our gratitude to CA Gururaj Acharya, sir. Thank you, sir. We are grateful to our SIRC chairman, CA Jalapathi sir, and his team for their blessings. The 3-day CPA program became a grand success only because of the guiding flair of our bigger brother, bigger, better, and bolder big bro, our own vibrant and energetic CA Jomon K. George. Jomon sir was very instrumental from finalizing the faculties up to the finest aspects of organizing this program. Thank you, Jomon sir, for organizing this program and for the superb session on the first day. Our dear chairman, CA Rajanish, CA Praveen Narayan, CA Prashant Srinivas, CA Aryan KK, and CA Ramesh Kumar and their team have taken a lot of strain from planning to getting the idea to an impeccable finish. Thank you, dear leaders. I've seen our attendance during the 3 sessions up to 308. This program turned out to be effective and successful only with the support of our dear members. I hope all of you are staying safe, wishing speedy recovery for those who are affected. Stay safe with masks and vaccines. On behalf of the participating branches, let me thank our honorable senior members as well as my dear fellow members for making this event a grand success. Once again, thank you all. Stay safe, stay healthy. Thank you. Over to you.
Sir. Yes, sir.
Thank you, Prem sir.
Thank you.
I should express my thanks to all the brothers in the other fellow branches, other 4 branches for coming together and make this happen. And I'm very thankful to the learned faculty members who made this a reality. And I use the same word, I repeat, all the faculties could take us back to the school so that we can look back. Now we can read the accounting standards with a fresh vigor so that we'll be able to appreciate and understand the things with a better perspective. Thank you all the faculty. Thank you all the participants. Let us stand for the national anthem.
Jana Mana Adhinayaka Jaya He Bharat Bhagya Vidhata Punjab Sindh Gujarat Maratha Dravida Utkala Vanga Vindhya Himachala Yamuna Ganga Uchala Jaladhi Taranga तव शुभ नामे जागे तव तव शुभाशिषमाहे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
With these sweet memories of a good weekend learning, I am CA Prashant Srinivas, Chairman of Kottayam branch, signing off. Thank you all.
Thank you,
Thank
sir.
you. Thank you, sir. Thank you very much.
Thank you.
Gururaj, sir. Thank you very much. Thank you, sir.
Thank you, sir.
Bye, sir.
Bye, sir.